Welcome to Blind Spot. I'm introducing today because Isabella can't say the name of the podcast. I'm John Seth.
And I'm Isabella Kaminska. So welcome, everybody. It's been a crazy week in crypto. But before we get to what's been going on in crypto, I just want a quick, present a quick housekeeping note, which is that you may have noticed me complaining on Twitter about my YouTube channel being cancelled randomly and arbitrarily. And they never said anything. It was very confusing. I didn't know what I did. I felt like I was in jail for without any probable cause. It was really unfair and unjust. And I had to create a new channel, which is where the pilot of this podcast was posted. However, the day after, immediately, I was given it back. And that is
nice.
So I've got it back.
The letter said you'd never get it back. It's forever.
My audience, because the pilot's on a different channel. So I'm going to migrate the pilot back to the main channel, the one that we've just got back.
Good.
But at the same time, so then we'll cancel the other one. But there's been mass fragmentation as a result of YouTube. I'm very angry with them. They never told me what I did wrong. It was just a mistake. Mistakes were made, allegedly.
All right. So we got Brad with us today. Brad is a nobody, which is, right, Brad?
Thank you. Guilty as charged.
Brad's a friend of mine. He's a Canadian Bitcoiner. And given the subject matter,
I love that that's how you've introduced him, a Canadian Bitcoiner.
Unemployed Canadian.
Unemployed Canadian. He's a member of your country, Isabella.
Oh, really? Are you British?
Eventually, I guess.
He's Canadian.
Oh, of course, because he's Canadian, right? So he's de facto part of.
See, Brad, that's how little they care about you. The Queen, who's on your currency, other than the loonie, barely knows you exist.
Well, I'm not the Queen, but thank you for
subjects. Or other subject. You're the lesser subject.
I'm the lesser subject. No.
You're the greater subject, Isabella. It's Brad who's the lesser subject.
You make a good point. Welcome, fellow Commonwealth citizen, to this podcast. I understand you have your own podcast. What is your podcast called?
It's called Brad Talks to People About Therapeutic Bitcoin and Shitcoin Issues of the Time.
I told you I didn't know the name.
Brad's Therapy Sessions.
A boot. I love that it's got an a boot. Yeah. Okay. Very good.
All about Bitcoin with Brad.
Brad, does your podcast not actually have a name?
It's called Magic Internet Money.
Oh, okay. That's what happened to me. He told me, he's like, you want to get on the internet and talk about some things? And then he and I got on, and I didn't know it wasn't like just a Zoom call. And then the next day it was on the internet. So
no, it was on the internet that day.
Let's get to the point and the heart of the matter now. Obviously, the Blind Spot podcast is yet to be sponsored by anyone. So I'm just going to be informally, referring to Aqua Libra today, which is my drink of choice, my beverage of choice. But whether or not they want to sponsor us is up to them. I'm sure, it's excellent product placement. You probably can't get it anywhere apart from in the UK, but there you go. Cheers.
Blur that.
Crisp. It's logo. Crisp and refreshing.
Do you know what it is? I've never heard of it.
Do you? Have you heard of it?
It's a 0-calorie, bubbly water sweetened with the extract of the finest plants from the Amazon and Aztec rainforests.
Brad's doing our reading.
That is very good research. Very good research. Exactly. It is very refreshing. So, other than that, though, what has been going on in the crypto world? Is it the end of crypto, Josh?
Yes.
It's the end.
Brad's going to take the other side of that. Brad, is it? No.
Yes.
Oh, that's not helpful.
Okay, well, now it's the end of a lot of.
It's the end of a lot of things in crypto. I mean, we've been watching. I mean, for many years, those of us who consider ourselves Bitcoin maximalists, of which a brand of person a club that both Brad and I belong to, I believe, we have been saying that everything on Ethereum and everything on a lot of these chains is complete horse duty. And I think that we're just being vindicated right now. And a lot of that stuff, I think, is coming to an end.
So, Brad, Josh made a very, he said something very nice. He said Brad predicted the downfall of Celsius almost perfectly.
And Terra Luna.
and Terra Luna, and that
And
unlike
Terra Luna.
other commentators on the internet, you actually know the mechanics of how it fell apart. So I thought maybe we'd
Right.
start at that point. Josh, just give a little backstory to those who haven't been following it. What is Celsius, and when did it collapse?
Well, Celsius is in the process right now
It's
of
not
collapsing.
actually collapsed. Fair enough.
It has. I mean, if you understand what's going on with it, you'll understand that it is collapsed. But what stage of grief are its buyers in right now? Brad, Brad's tracking
Bargaining.
this.
They're in bargaining.
stage.
Yeah.
So it's
Like
it's
literally
collapsed.
they were on their Twitter space saying maybe we can just all agree to stop accepting our yield for a month to help them shore up the reserves, and we can all band together and buy the Celsius token to help the Celsius community, and then if we agree not to take our yield, then we can make it through. They are trying
Brad,
to bargain with,
let me quickly
with
just
Mr.
sort of
Market.
so
what's
this
going on?
isn't. Sorry.
Celsius, as I understand it, and it's funny because as a Bitcoin maxi, a toxic Bitcoin maxi, I generally don't play in any of this stuff at all. I don't even bother looking at what it is because I know what's going to happen. The last time we had a pump, the ICO craze happened, and it was, I mean, you and I did a podcast back then in the UK, remember, at the very beginning of that, and it was just very obvious that this was the dumbest thing since sliced bread. Because sliced bread is dumb, since Wonder Bread. The dumbest thing since Wonder Bread. And it was, these things were popping, and it was, everyone was saying we have a new paradigm, a new stock market. And I was like, that's just not going to happen. This will just go away. And that's what happened. So in this cycle, we have DeFi. DeFi is decentralized finance. Decentralized finance is ICOs all over again. However, this time, instead of the companies issuing stocks, the companies are building smart contracts that they're in control of to issue all of the stock. And then that way they can say that it is not the same as an ICO, so they can avoid prison. So DeFi, Celsius is a DeFi protocol. Terra Luna, which collapsed a couple weeks ago, it was a DeFi protocol. And Celsius is a lending platform, right, Brad? Is that correct?
Yeah, I mean, Celsius isn't really a DeFi protocol, but it used all of the DeFi protocols. It's a centralized company.
DeFi, it's the same thing, basically.
I mean, basically, they were DeFi in the end because they took all your money and locked it into DeFi.
Well, DeFi is not necessarily non-centralized. We've discovered that, right?
Yeah.
So it being decentralized is not a matter of concern for the D part. Like, it just needs to nominally look decentralized. But they're kind of like a Coinbase, right? The difference being that
So, like, the thing that
there
I
may
like,
be no difference. Who knows? We'll see where
well, they're
Coinbase
way
goes.
more risky than Coinbase,
Yeah,
but
yeah.
Coinbase has an earned product, and that's what the SEC sued them over. Coinbase tried to introduce this, and then the SEC said, no, you're not doing that.
America
And
for the
then,
win.
what's that?
America for the win.
America for the win. I
Is Celsius
suppose.
American?
They are not American. They're Russian gangsters.
Ah, well, okay.
Are you allowed to
So-
say that? Are they going to come and sue us?
No, they're being arrested for fraud as we speak. You don't have to worry about that. The CFO of Celsius actually was arrested for fraud.
Today, was that today?
No,
I'm
it was about 4 months ago.
Oh,
So, I mean, this is why it was so easy to predict Celsius was going to blow up. If you just had any sense to look and see what was actually happening. So, Celsius was basically a honeypot for retail investors to earn yield on their money. So was Terra Luna. And basically, like back in 2020, this DeFi stuff started to get built out, and it was based all off on this primitive idea, not primitive, but this idea of building primitives of decentralizing finance. So in finance, you have things like borrow, lend, exchange, marketplaces that can be secured for borrowing and lending. And obviously you can have like analytics and all these different things, synthetic things, just like in the 2008 collapse when they were trading all these derivatives of the housing market between each other. They just decided like, well, why don't we just take all of that and put it on a blockchain and call it DeFi and make billions of dollars? What could go wrong? And then, so you get companies like Celsius that got started up to say, well, this stuff is all so complicated for the average person to get involved with synthetic derivative swapping. Why don't we do it for you? So you can, get your grandmother to sign up with her pension tell
So
her that
they
she's
were-
going to earn 10% yield, and then all she does is deposit her money into Celsius. She gets her 10% yield, but in the background, what they're doing is they're actually building LTCM on the blockchain, and like
Yes, exactly. That's what actually. It's funny that you mentioned that because actually, when you were saying that the current situation is in the bargaining phase, that was the incident that came right to my head. The LTCM.
Is that where the LTCM investors are now still?
Well, no, but
30 years
that was no, but it's worthwhile background, which I'm sure you know. But when LTCM was blowing up, there was a lot of pressure for there not to be a public bailout of it. So there were all these secret meetings where lots of stakeholders and different banks were clubbing together and different lenders to try and figure out a bailout plan, or so exactly how you were describing the current investors in Celsius trying to work their way out of this problem. And then many years. Sorry, go on.
I would say like the better way to look at it is like look at these layer 1 blockchains as companies in the crypto world, or sorry, as countries in the crypto world. Their currencies are basically like the bonds of the Soviet Union or these developing nations. So in the case of Terra Luna, the Terra Luna ecosystem was basically like the bonds of Russia in 1998. When the Russian bonds, when Russia defaulted on their debt, LTCM was actually Three Arrows Capital. So Three Arrows Capital is this $20 billion crypto hedge fund that was exposed to Terra Luna. And when Terra Luna collapsed and the price went to zero, they had all this Three Arrows Capital and all these other tier 1 crypto funds had all these leverage bets on Terra Luna continuing because, it was a sure thing, the smartest people in the world, right? It's basically when genius failed again, and the same thing that you're just describing, there is no central bank to bail out DeFi because they're not big enough. And just like in LTCM's situation, I think it was Lehman Brothers was the bank that called in their debt and they decided not to participate in the bailout of LTCM. Well, Three Arrows Capital was Lehman Brothers in this situation. Three Arrows Capital was the LTCM in this situation, and now there's contagion, even more contagion in the crypto world because all the other banks like Alameda, FTX, they're all basically exposed to all of this stuff blowing up, and it's just going to continually fall because it's all based on synthetic derivative nonsense. Like it's extremely high risk, over leveraged crap that was pumped up on this idea that we're gonna create a new financial system, and it's all going to be based on synthetic derivative leverage.
Right.
The only thing that surprises me in that explanation, Brad, is that you read.
I only started reading.
I thought that was a very, very good description of LTCM.
It's true because these things are causing cascading failures. Like that's what it is, right? Like,
but it's such a great analog because analogy rather, because it's that same sort of Schadenfreude, the smartest guys in the room thing. Like all those guys really did present themselves as having like fixed finance. So the co-founder is Alex Mashinsky. He is the one who has like recently come out and said, I think he came out to reassure investors, but then he didn't actually reassure anybody. What is the role in all this by is it Nexo? Was it? So yeah, can you actually explain the mechanics? Because I think my listeners who come from traditional finance, our listeners, Josh,
Yeah, well, real quick as well. Before we do that, I just want to say the difference, the stark difference between this and LTCM is that on a long enough time scale, most of LTCM's bets would have worked out, right? After they went bankrupt. And these never will.
Yes, potentially.
Well, how could that have worked? Because when they defaulted on their debt, didn't they just completely, like, it just ended and then they started anew?
Yeah, so like, but the thing is, not all of their debt was Russian debt. They had lots and lots and lots of bets all over. The problem with them is they had like these cascading derivatives that when one failed, it would cause a failure all the way down the chain. They thought they were fine. But then when what do they have? One or two different black swan events at the same time? Because like when you make enough bets, eventually the black swans pile up. well, that's, when they had that, then it just caused their entire portfolio to kind of fail. But if they'd had the capital, not that much, even like maybe $6 or $7 trillion, they may have been able to weather that storm. And then if they'd held it for like 20 years, they'd be way, way up today. That's the idea.
That's the kind of counter-cyclical theory that brought us bank bailouts.
I'm not saying. I'm just saying, Isabel, that these bets, like Celsius, it's going away. Terra Luna, it's going away. Like, these are not, like, when this cascade happens, like, Brad's going to explain the mechanics here of these protocols and how they work, but like, these things are going away. They're not coming back. Like, hold these for 30 years, they'll be worth 1/1000th, 1/1 billionth of a penny.
I don't disagree. Brad, let's get to the mechanics. I think I've got a bit of an echo. Sorry about that. Hopefully Horatio
I don't hear it.
Oh, you don't hear it? That's fine. So Horatio, Brad, tell us about the mechanics and the staking side of things. That's where my head hurts.
Sure.
I understand it.
I'll have to kind of walk you back to like 2 years ago, and it might be like a 5-minute explanation if that's...
Can we have like one of those, when in movies, when you think back and it's all fuzzy,
Yeah, I think we get Horatio, you heard the request.
Okay, thank you.
So it all started in the summer of 2019.
Oh, yeah. Do it, Brad.
So, okay, I'll go back even further than that. Like John Seth was saying, we had the ICO bubble of 2017 where all these venture capitalists from Silicon Valley started to see like the opportunity to disrupt venture capital. And they thought that they could create utility tokens and then get rid of this sort of unfair SEC regulated accredited investor thing where you have to have some kind of financial IQ to invest in early stage investing. And they said, well, with the blockchain, we can allow democratize access to the types of gains we get in venture capital to everybody. So your grandmother can put her pension plan into early stage unicorn that was probably going to blow up, but 1 in 1,000 chance it does 1,000x. So everybody can play the venture capital game. So that was the kind of idea. It was all this excitement. People that couldn't raise money from legit venture capitals, they were super pumped by the ICO bubble because their failed startup now had like FOMO boosters on it because of ICOs and crypto. And billions of dollars got raised in the ICO bubble. So, obviously that blew up when multiple things happened there. It was actually the affiliate marketing was driving most of that cycle on Facebook, Instagram, Google, and Twitter, and they all decided all at once in January 2018 to ban cryptocurrency ICO ads. And as soon as they banned cryptocurrency ICO ads, all these like Ty Lopez, James Altucher, charlatans that were making tons of money off of promoting ICOs, being unregulated broker dealers, they just stopped, and that stopped bringing in new suckers into the bottom of the pyramid. And when the new money stopped coming in, the whole thing fell apart. And all these dreams of disrupting venture capital and the Silicon Valley guys with their crazy MV equals PQ ratios and fat protocol theses and all this crazy nonsense that they used to value these stupid ideas, it kind of over 2 years totally went away. And people completely disconnected from this space. People that had come in and developed these massive followings and huge funds, they went back to being life coaches and Instagram models and, whatever they were doing before. They became crypto experts. So like you get to like January 2019, we're a year and a half into this brutal bear market. Bitcoin obviously is getting hit as well. And everybody kind of starts to understand for the most part that was all crazy. It was all a bubble. And there's, the SEC had come out multiple statements. They've taken action against multiple companies saying, this is an illegal security offering. You're not in compliance. They canceled the Telegram ICO, which is one of the biggest ICOs of that cycle. It was $2 billion that Telegram had raised to do the Ton coin.
I remember
and there was this, they had gotten shut down by the SEC. But you combine that with like, we all learned all these lessons. The utility coins were useless. You had no legal rights as a token holder to the treasury of the company. You couldn't claw back. You couldn't do anything except for trying to like sue these companies. But we learned the lessons. COVID happens, the Fed comes in, the Fed steps in and starts pumping up trillions into the market and keeping the interest rates low. It obviously drives people out onto the risk curve, and everything starts to go crazy. People buying Pokemon cards, shoes, anything you can imagine starts to go up in value because everybody's like realizing that all this liquidity and low interest rates is causing everything to inflate. So there was actually some things that had gotten built in this DeFi space that was kind of useful technology. There was something called Uniswap, which actually allowed you, just using your private wallet without registering on an exchange, to swap one crypto asset for another crypto asset on Ethereum. And
they invented a repo, essentially.
It wasn't a repo because it was actually just a swap. It wasn't a forward purchase contract. It was actually just like swap.
Okay, so but
it was an exchange.
Duration, like, was there a duration element?
No duration. No duration.
Oh, I see. You just swap it for the hell of it.
It's just like an exchange where you can put up.
It's bilateral. It's like bilateral exchange, right? It's more like that.
So the way it works is
it clears in what way? It clears through the today I log in and I can get like 2 lunas for my whatever. Bloody blah.
2 lunas won't even buy you an AT&T collection.
Right, but then the next day the valuation, like the ratio changes.
So I'll tell you how it actually works briefly. So it's automated market making is the way that this technology was branded, and it used this technology called a bonding curve, which was just a kind of thing that these Ethereum people made up. But you say you had 1 Ethereum and $100 of stablecoins, and you wanted to be a market maker and provide liquidity and earn fees on people swapping in that pool of money. So you would put up your one Ethereum and $100, because at the time Ethereum was $100. If you had 10 Ethereum and $1,000, whatever, you'd put up this pool, and the protocol using smart contracts would say automate the swapping between these 2 assets. So anybody that came in and decided they wanted to buy $100 worth of Ethereum through Uniswap smart contract protocol, they could do that, and there's no centralized authority there having anything to do with this protocol executing on the Ethereum blockchain. So you make fees based on the swapping volume. So it really is just like decentralizing the idea of market making and allowing people to take on the risk of whether they want to earn the fees or get wrecked providing liquidity in these risky DeFi markets. That was what it was. And that was actually a very interesting piece of technology, but nobody gave a shit about it. In 2019, in 2020, early 2020, the only people that were using this were DeFi developers, the venture capitalists that were seeding it all, and some like really early hobbyist kind of like scammers that were there trying to like steal people's money and stuff like that. Yep. They were trying to exploit the contract and do this flash loan stuff where you could take advantage of Oracle prices and all this. Anyways, it was super adopted. There was a couple of Ponzi schemes that were using it and all these smart contract devs and stuff like that. But the average like person did not see any need to go and use this thing because it was cumbersome to use. The user experience is horrible. There's high slippage. There's high fees. You might as well just use an exchange.
So this was all born out of a want to bypass the exchanges.
Exactly, because they all realized that they were doing well. Partly it was because they realized that they were violating securities laws and they wanted to kind of disrupt the regulators. And partly it was like actually people from the traditional finance industry wanting to rebuild everything that they had done in the traditional system on a blockchain.
Without regulation.
With no regulation, yeah. So in a way, at the very beginning of DeFi, there was some cypherpunks, there was some altruistic devs in there that they were trying to just experiment and build some useful things. And actually, Uniswap is a fork of something that came before it called Bancor. And Bancor created the AMM. Yeah. Yeah. It was
I didn't realize that Uniswap, Bancor was an ICO, Isabella.
It was. And that's the thing. Like, Hayden Adams, the creator of Uniswap, was pissed off that he was like an altruistic kind of cypherpunk dev at the beginning, and he was pissed off that Bancor took advantage of the ICO bubble to raise money for this technology. And he's like, I'm just going to do this myself. I'm going to fork Bancor, remove the stupid shitcoin, and deploy it myself as Uniswap. And so he did that, and he was like, I'm going to protest against this like charlatan capitalist sort of like unnecessary bolt-on token stuff because there's no need for a token for this technology. Well, fast forward a year and a half, Uniswap became the number one DEX on Ethereum. And what did they do? They pumped the token onto it because they could make $100 million each by adding a token. So he totally gave up on all of his morals and his original intent.
Brad, wouldn't you for $100 million?
I mean, why wouldn't you,
what
right?
They say, power corrupts.
Yeah, exactly.
But $100 million corrupts absolutely.
Yeah. What's your corruption threshold?
Me?
Yeah, both of you.
Josh.
Go on, both of you.
40 or $50.
Yeah, I'd say a good JPEG.
A good
A
day?
JPEG of a monkey.
Nice.
Show me a monkey JPEG anytime, and I'll do whatever you want.
You'll do whatever you want. Okay, great. Okay, so that's a good background. Okay, so now we're in the world of like post-COVID, loads of liquidity sloshing around. These altruistic guys.
Well, I'll tell you, actually,
sent money in the mail to us all.
Even before then. So Uniswap was the one primitive that was kind of an interesting thing that allowed you to go in and just use your MetaMask wallet or your Ethereum wallet to just swap one shitcoin for another shitcoin and earn fees as a market maker. That was kind of fine. Like that was like, all right, well, that's not scammy or anything like that. Sure, there's Ponzi schemes using it, like Hex protocol and all that stuff, were the number one volume coins, but whatever, like that's fine. There's nobody taking advantage of anybody really in that ecosystem. And it's not like they're trying to sell this as like a competitive thing to Bitcoin. They're not trying to say use Uniswap and make more money than, buying Bitcoin or whatever. There was a clear delineation between the separation of what Bitcoin is and what all this other garbage is, because nobody gave a crap about it. It was only quants using it and stuff, flash loan exploits and all this stuff. So then what they decided to do then was create a stable coin, make or die. That's another core piece of this whole story.
Maker DAI.
Oh, right.
Okay. Make or die.
Make or die. Make or dev.
Make or die.
Yeah.
Maker DAO actually is what it's called, but there's the Maker coin, which is the governance protocol, the governance coin, and the DAI token, which is supposed to be a stable coin. It's a synthetic stable coin.
And so, DAI is the first stable coin really to fail, by the way. I mean, there's been plenty of failures over the years, but like DAI is kind of the first big one, I think, at least as I remember all of these stable coins. It's the first one that had like a lot of adoption.
Well, DAI was basically like you get the maker, you over collateralize a vault, they call it, with Ethereum or wrapped Bitcoin or whatever asset that has some value. At the beginning, they started with 3x over collateralization with Ethereum. So for every $100 worth of DAI coins you wanted to create from nothing, you'd have to lock up $300 worth of Ethereum. So they created that pretty much when Ethereum was pretty high price, like $1,000. So they had gotten all these people to like lock up their Ethereum at $1,000 to create DAI coins. But then during the bear market, as the price of Ethereum dropped from $1,400 down to like $80 and Flash crashed even lower on March 2020, all these people in DAI, they had created billions of dollars of DAI tokens. They were at risk of being completely broke. The protocol completely broke because even at like 4x, 5x over collateralization, it's still not enough because the asset is so volatile. So the venture capitalists that funded DAI and that were in control of the whole thing, A16Z and those guys, they basically just plopped in a bunch of dollars into the system. They said, all right, well, we're going to put 50% of the value of it as USDC, which is just somebody else's dollars in somebody else's bank account. So the idea for creating Maker DAI was kind of an interesting idea to create a censorship resistant algorithmic pegged stablecoin that you could use in a crypto native network. and that's kind of an interesting concept, just like the ability to do an AMM and swap without any regulations. To have a native dollar peg token that doesn't have the risk of a bank coming in and freezing the assets or whatever. But now the whole thing is freaking more than 50% collateralized by dollars in some bank account that's regulated in the US. So at any point, they could 6102 attack Circle's bank accounts and freeze up the entire DAI ecosystem. So since March of 2020, DAI has been a failure, pretty much, from what they created it for. And it's just been LARPing as a zombie coin for the last 2 years.
It's essentially a pegged coin to USDC, right?
LARPing as a zombie coin.
It is, though. It is.
It's pretty much like a money market fund.
Yeah. I mean, like it's no different, and like it's no different than like Tether either.
Money market.
Well, yeah, but these so that's really the first like sort of failed coin, and they successfully didn't destroy the value. I'm just kind of surprised that that's
right.
Not what like every one of these does.
They kept the dollar peg, and they've actually grown still, because most participants in DeFi are just degenerate gamblers looking for yield. They're not actually giving a shit about the cypherpunk values of why this stuff was created. They're actually just there to earn yield. So they don't care that the thesis behind the DAI stablecoin censorship resistance part is completely invalidated because it's backed by USDC. They just are like, well, I can make a bunch of yield with it, so I'm going to use it.
And it's a dollar. It's a dollar stable coin, right?
Yeah.
And it seems to like kind of work as a pegged coin. So
those are
really, yeah. Sorry, go on, Brad.
So those two, so now you got Uniswap was the way to exchange without any intermediaries and any regulation. Now you've got a dollar pegged asset that's also native in this system that you can put up as a collateral pair in Uniswap. So you can, if you're worried about the regulators coming in and shutting down your scam because you have dollars, you don't have to worry about that anymore, technically, in this system, because you can use DAI, which was supposed to be resistant to scammers. I mean, to scam stopping. Mm-hmm. So you got a regulation resistant coin, a regulation resistant swapping mechanism, and then one of the last pieces that they needed to build was this thing called Curve, which was which is kind of like the repo market. Curve is kind of like the decentralized repo market, because it's not a spot sale and a forward contract purchase agreement or anything like that, but it is a deep pool of liquidity between multiple different assets. Kind of like how you have the HQLA in the traditional financial system. You have level 1 assets like MBS and treasuries. You have level 2A assets, which could be like corporate bonds. You have level 2B assets, which are like bank stocks or whatever. And they all have liquidity discount percentages. Well, and that's the deepest, most liquid markets in the traditional financial world, is these repo markets. And so they built that on DeFi with this Curve thing. So, and it's all funded by these whales and tier 1 crypto funds, where they create baskets. So there's like a tier 1 basket where they put in like the stable coins, because the stable coins are supposed to act like HQLA level 1 stuff. It's like always a dollar. It's extremely liquid. It's always a dollar. So they fill it up with all these different stable coins. Like this basket has Tether, USDC, DAI, and UST coin, which was the Terra Luna coin. So this is where the thing starts to become a house of cards, when they start taking things like USDT and USDC, which are backed 1-to-1 by dollars or treasuries and Circle's accounts or Tether's accounts, and they start mixing it in with these synthetic stable coins that have actually no value. And they try to create, it's like in the repo market when some bank tries to swap insolvent bank stock for level 1 assets treasuries. Yeah. You know, if that kind of is the same mechanic, because they can do it based on the rules. We don't know how much of that's going on, but they built that on the blockchain. And so at the beginning it was fine, because now you've got all these different tools where this is now attracting all these people from Wall Street and traditional markets to come say, I can go deploy my quant algorithms here and just milk retail and play this quant game of like flash loan exploiting everything and making just flash.
So remind me what a flash loan is?
It's basically an exploit of DeFi where you can front run somebody else's transaction kind of like purchase for order flow, like between Citadel and Robinhood, except multiplied by 1,000.
And order flow is free. See,
So
Isabella,
it's like a look-in.
Well, Isabella, the thing with blockchains is very simple. Everything on a blockchain is public. So if you're going to buy anything in one of these decentralized order books, everybody can see it.
So you have
all of your orders are able to be seen. So this makes it valuable to front run all orders for the two people that understand this. Number one would be the financiers. Number two are the miners, right? Because the miners can see all the orders. So in Ethereum,
how can they? So basically, they see the order and then they do a flash run. Like they pay someone to get ahead of the order book.
They don't need to pay anyone. They pay the miners.
The miner.
The miners.
Oh my gosh!
As a miner, it's essentially costless. So you have to pay a higher fee than someone to get in front, or you can just not do their transactions. So if you were mining Ethereum for the last year, 2 years, you're getting what's called MEV, which is miner extracted value, which is the act of jumping in front of all of these transactions and earning
that's insane. Oh my god!
It's the equivalent. It's the equivalent of when the high frequency trading.
I was going to say this is Flash Boys stuff.
It's actually dumber. It's dumber than Flash Boys because Flash Boys was working on milliseconds, but the Ethereum blockchain gives us 12 seconds to front run all the trades.
Well, what's interesting to me is that obviously with conventional HFT, it's the co-location at the server farm or whatever the exchange, wherever the exchange is based. That was how you would get ahead, right? Because your computers were closer than whoever you were front running. But getting ahead of but here there is no server that you can co-locate next to because it's decentralized. So
that's not entirely true. But, but it's
the servers are effectively the miners.
The miners.
Yes. So here's the thing.
That's the analog. The analogy is the miner is whoever's the most
difference. The difference, Isabella, is this democratizes the competency necessary to do Flash Boys. Because if you wanted to extract value from Ethereum trades, all you had to do was turn on a computer, get a graphics card, boot up a mining software, and then join a mining pool. And they did all the work for you. So mining pools were actually doing all the work of extracting miner extracted value on behalf of their pool. And they were competing for a long time on basically advertising that they were better at it than the other pools. So you could switch pools switching pools takes 2 seconds if you're a miner. So you don't have to have any competency in this. All you have to do is point your miners at a pool that does MEV.
Mm-hmm.
So I've been a Flash Boy for months.
And another even worse, another more insidious part of this whole thing is that during this entire nonsense bubble that was getting started with Ethereum DeFi stuff, all the VCs and all the Ethereum maximalists and Ethereum shills were all saying this is for the people. This is better than Bitcoin because it's cheaper to use. And you can do decentralized finance. It's going to unbank the banked and bank the unbanked and all this stuff. And meanwhile, really, it's just this reverse Robinhood scenario where you're trying to get yourself through to your destination, and then all these evil Robinhood characters are picking your pockets through the whole trip and stopping your caravan and taking your goods from you. Because if you try to use Uniswap, you're going to get flash loan exploited. If you're a retail person, you can't afford to use it because all the quants are taking up all the block space, and the transaction fees to use Ethereum rose so much that it got to $50 a swap to send some stable coins to somebody. So that narrative completely broke down in summer 2020 when the first DeFi bubble kind of went nuts, because in summer 2020 they did the final piece. The final piece which caused the bubble, which was the Borrow Lend protocol. So now they created these protocols where you could deposit any collateral, including ICO shitcoin pre-mined security things, and borrow level 1 assets like stable coins. And so that attracted a lot of people that had all this garbage junk to be able to deposit it into these lending protocols and take stable coins out, and then earn a yield. The yield farming thing was
This is basically what the ECB does, by the way. There was a
Is
great, there was a great piece from 2008 where I think it was William Bouter or something, like essentially exposed that the ECB was a bank that took trashy assets and lent out, liquidity against them. This is essentially same model. As we now know from the ECB meeting, they're now defragmenting, or rather anti-fragmenting, with their own. Well, they're trying to detrash it, but it's a bit hard to detrash it. But anyway, go. Sorry about that. So, go on.
The yield farming thing was really what caused this thing to go into hyperdrive, because as I said, like nobody else in the crypto world gave a shit about this DeFi stuff because it was too obscure. It was an unfriendly user interface. Yeah. Unless you were some really intelligent quant dev that could like exploit everybody, they're like, what's the point of using it? But then
at that time, you wouldn't have been exploiting very many people either. That's the other.
You're just like
on the exploitation side. Once your order is in the order book, you can't reverse it, or can you still?
No, you can't reverse it. Isabel, think about it this way: miners order transactions. That's all they do. So when you're a miner, you look at the transaction book and you can pick whatever transactions in any given book you wanna do, including, for example, your own transactions, right? So because if you win the block, the thing that you ought to do is basically mine your own transactions and reorder the book such that like you are ahead of people in the book. It's a very simple, like you have not milliseconds, you have the full time of finding that block to look at the book and implement any changes that you want.
This is so much worse than traditional finance.
It's so much worse. It's so much worse. Like that's why for 2 years now I've been just harping on this. Like they're just rebuilding everything that's wrong with Wall Street on a blockchain.
Without regulation.
It's the stupidest thing that we've ever done, and now it's all blowing up. And who could have predicted it? Gee, all the Bitcoiners, perhaps. Anybody that understood the follies of like the financial system and why we shouldn't rebuild all of that transparently on a blockchain system, and make it 10 times worse.
And is there any such thing as a dark pool in this game?
Yes, there's dark pool protocols. There's LIBOR markets. Like that's the most insane thing is when you see uncollateralized lending. Like interbank lending, LIBOR stuff in DeFi. That's why it's blowing up even more right now, because they started to do that. They got kind of hubristic and they thought like we're so successful, we're so smart. Look what we've done. So they started saying, let's do uncollateralized lending like the financial system. And so there's this protocol called Maple Finance right now, which has 5 big pools in it that allows high credit uncollateralized lending, and they have like credit experts and risk experts in this protocol, basically trying to be like the credit agencies. And I went through the tweets of these credit experts, and they're like 3-4 months ago, they're talking about how long they are on Terra Luna and how they love Ponzi schemes. Like anybody that knows anything about sustainability, you see something that says you can get 70,000% APY and you immediately laugh at that and say that's ridiculous. You're a moron if you think that's not a Ponzi scheme. These credit risk agencies in DeFi were rating that shit as pristine. They were going long on it themselves. So you got to wonder how much toxic debt is in these unsecured lending pools. And now that Three Arrows Capital, which is one of the biggest market makers in DeFi, is blowing up, is completely insolvent. I mean, they are exposed to like there's so much unsecured lending going back and forth between these tier 1 crypto funds that it's just not even started yet. Like the whole thing's going to implode.
So let's unpack the Celsius story. So from a mechanic and the whole staking thing. So Celsius is how would you
okay? We're almost there. We're almost there. I got that one last piece to explain about the yield farming. That is the key piece that causes this whole story to go. So yield farming, like Junseth said at the very beginning, the original ICO stuff, we realized in the bear market that it was all toxic trash. It was all nonsense. It was just a dream. But then when
some of us realized in the bull market, that's fact.
But then, like when the markets hit the fan and the Fed prints $10 trillion, the Fed, the Treasury, the commercial banks, when they all inflate the supply of money and keep the interest rates low, everything goes crazy. And then everybody goes out onto this risk cliff saying, well, if we're going to make money and
It is a risk cliff.
that's what I call it. Like there's no risk
a
curve
risk
in
cliff.
crypto. It's
That's
a risk
what
cliff.
It's a risk cliff. I love that.
I love it. I love Brad.
How
I
far
like
out on the
Brad.
how
He's
far
great.
out on the risk cliff are you?
They're all out on the risk cliff right now. They're like Wile E. Coyote.
Wile E. Coyotes as far as you
Don't
can
look
go.
down. Don't look down. Everything will be fine.
Hey, hang on right there.
This is crypto. This is a financial innovation here. Don't
This
look
is
down.
great. This is great. Okay, they're on the risk cliff. I like that.
So they're going out on the risk cliff because the regulators have sent a message that we are overwhelmed. We cannot stop this. You guys are kind of in violation of the law, but we're too overwhelmed. The traditional markets are about to blow up. Like you look at what happened with Citadel and Robinhood and all this stuff, and you know the meme stock pumps and insolvent companies like Hertz getting pumped on the stock market. Like it's clear that they weren't in the driver's seat. So everybody, and the biggest ICO of 2017, EOS, raised $4 billion. And the resolution to that was to get hit with like a $20 million fine and allow them to keep the rest of the money. I mean, that's
it's just a tax. It's just
it's like, okay, I'll do that too then.
with agreements to absolve everyone in all of these cases, to absolve everyone of criminal liability, by the way. So they'd raise 20 billion, they would go to the SEC, the SEC would charge them like 20 million and give them an agreement to be absolved of all future criminal liability on this. Well, not like
but there
all
was
future, like all criminal liability.
a couple of cases where they didn't play ball with the SEC and they tried to fight back and say, we're going to fight back for crypto. Like everybody join us.
Just fucking pay.
They should have just paid.
Pay.
Because
It's
those
a
cases,
tax. The SEC-IRS is coming your way. Pay it and then and walk away with your $19 billion. Like, is that not enough? Really?
Yeah, really.
Mental.
So the SEC did take action against probably 10, 15 ICOs, but like the majority of the ICO activity happened after the crash. So in January 2018, that was the peak of the last bubble. And then it was a tsunami of deals that kept happening for another 6 months before everybody realized at about this point that, wait a second, this was a bubble. It blew up. We were idiots. And they started to just desperately look for liquidity. All the deal flow stopped in about June of 2018, and we're pretty much mimicking the timeline nearly exactly 4 years later. So I'd expect in a couple of months, it's just going to be a ghost town in all these deals, and everybody's going to be trying to find as much liquidity as they possibly can because they realize this was a fun game, but it blew up, and you got to count your chickens now. Like, you don't want to be the last person holding the bag in this bubble. You want to actually take your money out and take your profits. But it's too big now. The last cycle never got this big, and the SEC put a huge damper on things. So, but this cycle,
also, I think it's worth pointing out. I think the difference this time around, there's a hell of a lot more hedge funds in this now.
That's what. So you get to like the guidance from the SEC was like, this is not in consensus. I mean, this is not compliant. You're violating the law, but we're overwhelmed because in January, March, April 2020, they were still only at about September 2017 for the cases they were bringing against the previous cycle's bad actors. So they're a whole cycle behind in taking legislative action or taking action against these companies.
Which means you just got to wait 4 or 5 cycles, and then you won't get hit for a lifetime, maybe 2 lifetimes before they like get to your case. Let that packed up.
So that pretty much.
And Brad, they have only got to, I don't know, 5% of the scams from the ICO cycle.
Well, they pretty much gave up on it because this cycle got so crazy. So after the Black Thursday or whatever, when the markets crashed and the SEC, and the Fed and the Treasury started kind of signaling infinite cash, infinite liquidity and all this, it reinflated the idea that you could just go ham on this DeFi stuff because they created this concept of liquidity farming, which is basically like John Seth said, ICOs 2.0. Instead of you give me money, I give you coins. It's you give this smart contract that I built money, and the smart contract that I built gives you the coins. But I'm not giving you the coins.
And that I'm in control of still.
And that I'm in control of. Yeah. I built it. I'm in control of it. I pre-mined all the coins, but I'm not giving you the coins.
And by pre-mined, I mean I put money in too, and it also gave me the coins back.
Well, they didn't even put money in. They just like.
So that is like, so just for our
on creation
traditional finance viewers, readers, listeners, whatever. So yield farming is specific in the sense that it is. So give me some names of like yield farming products that people might have heard of.
So the first one was Curve. It was called Curve, Yearn. It was these lending protocols. And there really is no other parallel in traditional finance. It does not make any sense.
You stake something, and then you
imagine this. Imagine you were a hedge fund, and imagine you were a hedge fund.
Imagine
and you wanted to go to the repo markets and borrow $1 billion of treasuries.
Mm-hmm.
Well, in the repo market, you have to pay a small overnight fee for that, right? You pay whatever the rate is, like 0.05% or whatever the rate is of the repo market. So there's an economic calculation there that you make as a capitalist that like I have to pay to borrow $1 billion of this treasury collateral. In DeFi, you go to the repo market and you get paid $10 million to borrow $1 billion. That's what yield farming is. You get paid to borrow as much as you possibly can, and like you get paid for volume. So if you want to wash trade, you get paid. If you want to be in the reverse repo market, you also get paid. So if you're a commercial bank and you've got base assets at the Federal Reserve,
anybody making money out here?
If you're so the reverse repo participants also get paid $10 million for providing capital. Mm-hmm. So both participants get paid.
At the same time.
That's financial innovation, right? Like why wouldn't
this payment? So
don't ask questions like that. That's a boomer question. You just don't understand financial innovation.
Yeah, Isabella.
You don't get crypto.
I'll be the boomer in the room. Who's funding it? It's
the
just
smart contract. The smart contract.
The smart contract prints money. The smart contract prints.
But surely these smart contracts, like I thought, there was some sort of scarcity principle in these smart, like in these things. But you're saying that's just like,
I watch a lot of Real Vision, and Raoul Pal and those guys tell me that it's basically risk free. So,
Brad, the smart contract. The smart contract is printing money, essentially, right? It's making tokens.
It's stupid.
Yeah.
It doesn't make any sense.
But is it on some sort of schedule? Is there some sort of like
Isabella, it doesn't matter. They can make up whatever rules they want for the smart contract.
So here's the thing.
There is no limiting principle in this industry.
18% return product.
Yeah, so here's how it makes sense. It doesn't make any sense, but here's how it was able to survive so long. So you had this bubble of 2020 where all these like early crypto degen trader guys that were not paying attention to DeFi before this, the hedge funds or the crypto trading, million follower accounts and all this stuff, the guys that were super active forever in trading cryptocurrencies on exchanges, they didn't care about DeFi because it was like, it's too cumbersome. I don't understand it. But the minute you start getting paid to trade and borrow and lend, you're going to put your money in there because it's like free money, right? So it started sucking in all these degens and all the crypto exchanges and everybody that was doing market making to start providing liquidity. Because if you can get paid to provide liquidity, of course you're going to do it. Like imagine you got paid to use your BlackBerry. I mean, I'm sure BlackBerry would still be a pretty big company. If you got paid to use an inferior product, you'd probably use it a significant amount of money.
Like a Microsoft phone.
Yeah, Microsoft phone. I'd still be using my old Nokia if I was getting paid like $1,000 a month to use this. I use
a Razor.
It doesn't look like it, man.
So basically, there are all these liquidity pools. Those pools, we don't know how they're funded. Like they're not funded. Are they funded in real money or are they?
I'll tell you what it was not that you get paid $10 million. You get paid 10 million shares of some insolvent bank.
Right.
And then the banks are putting up their money as temporary collateral to allow you to sell the insolvent bank shares for dollars. So it appears like it's worth something. Right. So the hedge funds, the market makers, and the venture capitalists that pre-mined it all, they would use their giant pools of capital as honeypots for retail traders. So when there's a yield farm happening, they go and they pair the stupid token that they're issuing for you with some actual money on Uniswap and create a market for it. So they would take their coin that they created from nothing and give to you for a reward for using the protocols, and pair it up with some dollars and some, $10-20 million deep liquidity pool. So you start saying like, wait, this is actually worth something. Oh, well, now I can calculate this out as an APY. Wow, for using this DeFi protocol, I'm making 50% APY. I'm going to go tell all my crypto buddies about this, and I'm going to put my money in. And so it's a honeypot. It really is false advertising to create this phantom value that this stupid coin is ever worth something in the first place. So they go and they use the DeFi primitives like Curve and Uniswap and Borrow, and then they start taking this thing and they make you even feel like it's even more valuable by letting you put it up as collateral in the Borrow protocols. So then you can, instead of selling your stupid useless reward token that you got paid to use this thing for, you can borrow against it. So then you stack it in, and then it removes sell pressure. So you can borrow against it, borrow some stable coins, and then go and do more DeFi stuff and start stacking your yields on top of each other and just keep borrowing from the reward tokens.
And this is what causes the LTCM-like effect, because what's gone on here is that all of the DeFi projects are essentially collateralized, like stacked collateralization of other Ponzi's. It's as if Madoff got in bed with 100 other people, created 100 Ponzi's, and then got banks to do like equity loans against your Ponzi tokens. And then when one went under, all of the other Ponzi tokens went under too.
It is a lot like Madoff, eh? It's quite a bit of similarities, because Madoff
also was, he was a exchange guy. Like, that's his heritage. He came from the world of exchanges. Like,
was he president of the NYSE or whatever?
Yeah, the NASDAQ. I think it was
NASDAQ. That's right.
So you get this boom in 2020 where all these 10,000 crypto traders, which is not anything compared to the users of Bitcoin. It's just the degens on Twitter and the circle, the incestuous pump and dump circle of crypto, VCs, traders, devs, pumping each other's bags. Mm-hmm. Well, you get those guys, but then you got this insidious relationship between the venture capital firms like A16Z and Coinbase. They create liquidity by taking these stupid pre-mined, useless, trash DeFi coins, putting up honeypot liquidity pools in DeFi to create froth, and then putting them on Coinbase and advertising it to retail who are too dumb to use DeFi, or shouldn't be using DeFi, or just don't want to take the time to learn how to use MetaMask wallets and stuff. They put it up so it's easily available to be purchased on Coinbase, and then that's where as a coin that they can trade, and that's where they get their liquidity and they start dumping it.
But this is classic kind of risk recycling that the banks conventionally did. So you would have that sort of the banks use structured products to lure in the retail side. And let's you remember Paulson as well. He created this complex derivative structure to help short subprime, and then someone else had to take the other side of the trade, right? So that would be the retail or the institutional side. You always have to have a sucker side to fund the madness, right? So essentially, Coinbase was potentially facilitating the pathway to real money because the retail in this equation is where the real dollars come in. Is that fair to say?
In 2020, it was like that was the kind of insidious thing that was happening. It was that Coinbase has a venture arm. Coinbase goes with A16Z, invests in these stupid DeFi pre-mines. They actually create all of it. They create the supply of DeFi protocol coins. They pre-mine it through their venture arm and with A16Z. Then they go and they provide the liquidity in the DeFi pool and basically wash trade and create this market where it's like, oh, this is a profitable venture, I should do it. Then they go and they put it on the retail exchange. And so they were involved in the whole thing. And it's not just Coinbase, it's all the crypto exchanges and crypto funds doing the same type of thing. So that was happening in 2020. and it was really nonsense. It didn't attract much retail people because it was a lot of like obvious Ponzi scams. It was people having a lot of fun with like food tokens. It was like, this one is yams and this one is like kimchi, and it was like the stupidest kind of like nonsense bubble because it was all pancakes. It was like, it was nonsense, but it got up to billions and billions of dollars. And then what happened was one of the biggest exchanges
in terms of real money. Like what I'm trying to understand or unpick is, because obviously there's some sort of multiple going on, right? But what is the seed value in the system? Like when it all unravels, like how much base capital? Like in 2020,
it was billions. Now it's hundreds of billions.
Of the base capital, like as in how much? Oh my god! Really?
Yeah, because A16Z raised probably $500 billion in the last 2 years to pump into this shit, like A16Z and other funds. It was insane. It was nuts. Oh wait, sorry, I'm saying I'm too high of a number. 200 million, I think, was there. Let me just check.
Yeah, better check before we get a libel suit. It was not 500 billion.
No, it wasn't that high.
You can't say anything in the UK. How do you guys do reporting?
Yeah, it was billions, 2 billion.
We do something called fact checking, Josh.
Yeah, it was like
no, you don't, because you can get sued for facts in the UK too. Look at Amber Heard.
What?
It was 2 to 5. A16Z raised about $2 to $5 billion between their different crypto funds, but there was many other players besides them that were doing this in Asia and different circles of crypto. Like the one big there's two big players.
Can I interject with one point? What I've noticed in the last week or so, it's summer party season. I went to a posh summer party shtick, whatever, at an art thing yesterday, and this is often very telling, right? Because art is, always hedgies are always in art affairs, events, etc. Because that's what they do. They make money and then they buy art. And there's a lot of crypto people. There's a lot of crypto art. There's, it's quite clear to me that is the new wealth pool that goes. So it's a massive recycling in a funny way. So the money from hedge funds, from yield farming and all that stuff going into the art market, which is now going into NFTs, and it's going to make entirely circular.
It's
that's an aside. Go on.
Yeah, it's a marketing funnel. The NFTs was basically a marketing funnel for DeFi and Ethereum. And a lot of whales in that system, DeFi and Ethereum, they manipulated the prices in the early days of NFTs to spend obscene amounts of money on NFTs so that they could create huge headlines and then attract like Christie's and things like that.
100%. Those valuations were not done through any market mechanism. They were pre-organized and they were a form of marketing spend. That's basically what it was. Yeah,
they're trying to legitimize what they're doing with all this nonsense by saying, oh, but look, artists can get paid and this is a thing we can use this for money to disintermediate those predatory middlemen in the art world. I
did my best to warn Isabella. I said from day one, I told everyone what this stuff was.
No, I agree. And I mean, what I find NFTs interesting in that, because I'm quite arty, so I like the idea of art having value. But I've always said there's no value in it because the law is not there's a mismatch between what the NFTs are claiming.
The law doesn't matter on this because
even if it did, I mean, it's obviously it's more an attention market than it is an asset market.
But my point is the law doesn't matter because it's not the art itself. Like the problem is that art is the art itself. There's only one kind of art in NFTs that is the art itself, and that's the Rare Pepe. And that's why right. Because that was commentary. It's the only time that a hash has ever been turned into art. All the other hashes that came after it were scammy. And it's just really funny to me to look at because like this is literally a receipt. That's all you got with the NFTs. And it's just and Brad's right. It was a marketing funnel into the rest of DeFi. And they preyed on artists. That was
I think that's actually very true. And I think there's going to be a lot of collateral damage in the
I
and the
tried to warn the artists. I was telling them they don't know what they're doing, and they're going, "Well, I'm making a lot of money," and I'm like, "Well, that's too bad. I guess you weren't in it for the art then. Too bad." No, but they were they were making a lot of money, and I mean, who made the most? Probably like the Damien Hirst team. They always make the most.
Did
Hearst,
they? Did they do NFTs?
They made a ton. Yes, Hearst has a bunch of NFTs, at least one, but he made a lot of money on it. The Hearst team made a lot of money on NFTs, and that was the thing. Like
even The Economist had an NFT.
Yeah, it's really,
Time Magazine.
it's really sad.
Yeah, Time Magazine had an NFT series last summer, and they had to ban 8,000 people from their Discord channel for being racist.
Oh yeah, but let me point out with like The Economist also allowed OneCoin to sponsor their conference, so like they don't have a great record here. Yeah.
I had an NFT, but nobody bought it. But I did it just for like shits and giggles, as they say. And what I found is that it's obvious that like unless you have either a prearranged like funder or you have the means to market it in some ridiculous way, you're not gonna. It's not a mechanism to make any money. Like it's just it's just silly. Anyway.
It's an insider's game for
sure. We're going
sure.
to get to the Celsius story.
Yes. So now we understand that there was this yield, right? And the only reason why the yield made any sense, it was actually just issuing shit coins and then creating a market for the shit coins so that you could multiply the price of the shit coin by the dollar value that you could get in Uniswap and then calculating a yield. So they would just advertise high yields like 50% APY to borrow on this protocol. And that attracted large pools of capital from crypto whales to be like, well, I'm going to put my money in this smart contract then, because as I do, I'm going to get more tokens. And the tokens I can sell for more money because the VCs and the market makers were putting up their pools of collateral to allow you to have liquidity. Then they realized that like as it's growing, more and more people are selling this stuff. So the prices are going down. So they created the borrow lend protocol so that instead of selling it, you can just lock it up into this borrow lend protocol and then get more yield because now we're going to pay you. The
borrow lend protocol, that's not what we were talking about before, where it was the collateralized one. This is the non-collateralized one.
No, they're both collateralized. One of them is an exchange. One of them was like the I guess it's kind of like the repo as well, except they're both kind of like a repo market.
They're all like the repo.
Except it's not like a forward sale sort of agreement thing. It's just literally like a pool of capital that's fungible. So it creates fungibility as like a quality of tiered assets. So Curve was one of the earliest DeFi protocols where they could create fungibility between the different tokens. So USDT, USDC, DAI, and any other stable coin that was meant to be algorithmic or backed, they could create this fungibility between them so that if you had made $1 million, you could just instantly through the smart contracts just swap it for whatever. Just like a MBS is swapped for a treasury.
This is just conventional finance. I mean, that is how dollars...
Without regulation.
That's how dollars achieve fungibility, which are all in...
Venture Cap figured out that they could recreate traditional finance here and trick people into thinking that this was new and just extract the hell out of people. And they are, I don't understand. I mean, the government is so far behind that they're never going to claw back funds or return them.
It's very important, I think, because I don't think that's been picked up by the mainstream, by which I mean the traditional finance sector. So the fungibility point is essentially like in conventional finance, you have all these different banks also creating money out of thin air, frankly, but they invest in, they have a lending business. They're supposed to be lending to small businesses or for mortgages or whatever, right? They're creating assets with their loans. But each bank has a different profile of assets. Each bank has a different sort of risk, credit profile effectively. And to ensure that the money because as Francis Coppola is very good at pointing this out. Banks lend before they fund their lending, right? So if you're lending as a bank, you just like credit someone's account and then you do the funding. It just pops up as an asset liability, right? Match, but you have to match it eventually with some funding. Now, when when you
And usually they borrow the funding from the repo market.
then that's where they borrow it. And in theory, all of that is a merry-go-round, right? Because when you as an individual bank, when you create your whatever HSBC coins, I'm not specifically, this is just an example. HSBC's coins are like an effective, sorry, HSBC shitcoin. And it has to achieve a fungibility with NatWest shitcoin, right?
Yes.
If now, what is the thing that makes the HSBC ones merge with the NatWest ones is essentially the fact that they all are squared and settled through the central bank, and the central bank, is the ultimate police enforcer to make sure that everyone's assets balance out. But in the day-to-day, they have a decentralized liquidity market. This is what happened in 2008, is that in LIBOR, they are trying to avoid having to go to the central bank to square off any imbalances in the system. And they have their own sort of community amongst themselves where they're lending and borrowing, spare capital or spare liquidity as they see fit to ensure they always balance and they can avoid going to the Fed or the Bank of England or whoever. But in theory, the way it actually works to achieve that fungibility is they don't. It's actually more like a cross insurance market than anything else, because they're essentially saying if you HSBC are short at the end of the day, and you might have to go, to the Fed and borrow whatever. Well, we will, someone in our little clique of banks will lend you the money, so that you can avoid it. Now, what happened in 2008 is that everyone's credit profile became completely uncertain because the underlying assets suddenly got vaporized. What we thought had value didn't. So this is absolute parallel to what's going on in DeFi now. And
yeah, it's a confidence game. Like the central banks are the confidence brokers in the traditional system, and there are no confidence brokers in DeFi. That's the problem. That's why it's all going to tumble down and fall apart.
Well, there's no one here to come in and basically be the ultimate counter-cyclical buyer of all this crap.
Right. They're all making capitalist decisions at some point, just like JP Morgan in 1907 was going to, during the Knickerbocker, what is it? Knickerbocker? I forget how it's pronounced. Crisis. There was basically they rebuilt everything that we've done in traditional finance without the central bank. So JP Morgan was acting as the buyer of last resort during that 1907 crash, when all the trust funds and the banks started to have runs on the banks. He came in and provided liquidity and kind of organized the rescue of the financial markets after a bunch of failures started cascading to the rest of the markets. But after that was kind of allegedly the impetus for why the bankers lobbied for the central bank, because there needed to be somebody to provide liquidity and to be the buyer of last resort for
you didn't want to have to depend on the JP Morgan whale, which is basically what was happening.
And that's where we are right now in 2022. We have the JP Morgan, but we don't have the central bank. But I don't think that's as...
the next evolution then will be all of the participants clubbing together and arguing for the creation of a central bank. It'll be hilarious.
That's everything in crypto, Isabella, you have to realize is a bunch of millennials and zillennials getting together and thinking that they've discovered something new. And everything they do has a pre-existing thing. Everything.
Absolutely. Nothing new under the sun.
And they don't know that. So it's very rare that any innovation actually comes out. And what they usually do is whatever exists, but worse. And
no, they just create new names for conventional concepts.
No, it's different. It's whatever exists, but worse. Because,
it's worse.
It's worse because they don't understand. For example, generally when things grew up out of the organic. So before computers, you had the Rothschilds, start a bank, whatever. And, the Rothschilds were making loans to countries, and they were finding out the risks of making those loans. So what happened is over time, they developed better practices, and countries developed better practices and laws about how to take and give loans, and et cetera, et cetera. And all of these things kind of were iterative, and they countries regulated as things blew up and failed. Well, in this space, we have 1,000 years of banking history, 1,000 years of expectations. And what that means is if you want to create what we have today, you have this very fast-paced creation of everything that has occurred over 1,000 years in finance. Yep. And you have them all created today without regulation.
Yep.
And
So
100%.
and not just that, like that is such a good point, but it goes back to that thing that we said earlier, like all of this is built on a quicksand foundation of you get paid to do everything. So it attracts the worst participants because they're all fair weather friends trying to leech value from the system. And as soon as the tide turns, they're gone because they're only there to make money. They're only there to extract yield. And they're attracted by this yield. The VCs and funds put up these honeypots of yield. And so lots of people rushed in to get the yield. And when the bear market comes, and it's clear the yield is not as the risk of getting that yield is not as good as like the collateral you're using to get the yield going down 90%. Everybody runs for the exits, and that's when the whole thing implodes because the entire thing was built on this like perverse incentive of getting yield from these stupid shit coins, paying you to do the activities, and so the whole thing is like a liquidity vacuum. It's even worse than the other systems because you know the game theory is like who can get out the fastest. Now it's at this point it's like who can get out whole. And so there's like almost a competition happening. And like I said before, there was like we're about 6 months into the obvious top of the market and the bear market happening in crypto. In a couple of months, it's going to be like depression. Like these people are in like they're in the like denial or panic phase of the greed and risk, the greed and fear cycle.
I thought they're further down. Like that's interesting that you think
they're not even that far down. They're not even at capitulation yet. Like in a couple of months.
Like, having been around a few like crypto themed events, I shan't name them, but what I found fascinating is how these a lot of them are crypto hedgy people, how resilient their mindset is to like the fact that they lost, you know, oh yeah, we went through Terra Luna, oh my god, we lost a bomb, but like we're still going, we're gonna keep going.
Like in our world, in Brad and my world, if you admitted to getting stuck in Terra Luna, that is admitting that you were so dumb that Mavrodi could walk up to you and say, I have an investment for you, it's a Ponzi scheme, and you go, take my money, all of it. And then you're like, this is a legitimate Ponzi scheme, though, right? And he's like, yes, a legitimate Ponzi. And you give it, you're like, yeah, it's a legitimate Ponzi. It's a pump until the whole world lives in.
Very good name, LPS. LPS coin, very nice.
Pump and hold.
Yeah. So like this was an obvious Ponzi, and hedgies got stuck in it, and they're talking as if like it just like we couldn't know, you know, it was LTCM. It was Nobel Prize winning economists. And how could we have known it was a Ponzi?
Though, they're so forgiving about their bad performance. It's really like, oh yeah, well, you know, it's like
we thought it was a sure thing. Who could have guessed?
Crypto collapses, and I'm still holding.
So, like, okay, we get the yield, right? The yield doesn't attract retail in 2020. It attracts the crypto funds, the crypto degen traders. It was like 10,000 people playing around with billions of dollars of actual capital inside of this gated ecosystem in the Ethereum DeFi world. But it wasn't attracting retail yet because it was too early, it was too complicated. You want to know what blew up the DeFi system in 2020? This is going to happen again. This is why it's blowing up now. It's already played out once in DeFi. It's going to play out again the same way. There was one protocol that got created that was called Cream Finance, and it was a fork of the other one that was accepting the tier one. Remember I was saying they had this protocol creating fungibility between the different tier one collaterals? Well, this guy was like, we're going to pre-mine our own version and make a 10, 20, 30, $50 million off of our own protocol, but we're going to let anybody deposit whatever they want, any collateral. So if you got sushi tokens, if you got hay tokens, if you've got, you know, Xbox tokens, like whatever the hell, like everybody's just creating all this nonsense and putting up liquidity pools. And this is like level nothing. This is like these guys mixed and matched anything. So it created this real
subprime.
It's worse than subprime. It was like the subprime DeFi. Underprime. It was like, actually, you know what it was like? It was like in the 1990s when Wall Street started creating these structured products overseas, getting the credit agencies to rate it AAA based on the one like piece of collateral. there was a piece in the basket. They would basket like mortgage, sort of like agency MBS, which is tier 1 collateral, with crap subprime stuff, and then they would get the agency to rate it A because there is some A in it, and then sell that to like retirement funds in the US or municipalities.
It was financial engineering, and the way they did, like they synthesized a sort of AAA or high quality asset out of the structuring of how the different tranches pay out in a liquidity issue in an event. So even though it was always, the funny thing about that entire situation was that people who held the shitty tranches, and like you bought it and you priced it right, you bought it as a shitty tranche, they did okay. It was the people who held the top tier tranche thinking it was top tier, and it wasn't, that failed. But like, it is exactly.
Is that the 2008 version of it or the 1990s version of it?
That was the 2008 version of it.
So I read this book called Fiasco by Frank Portnoy, and in that book he describes the genesis of the whole like synthetic structured products thing.
I didn't know about this. No,
such a good book. You got to read it. It's so interesting, and it's exactly what DeFi is. Like it's DeFi. It's DeFi now. It was the creation of the whole structured products thing in the 90s, and because there was no regulation at all back then. And, even though it was crazy in 2008, it was even worse in 1990s. It just wasn't as big. So it never blew up the whole economy. That's what DeFi was. The equivalent of DeFi in summer 2020 was basically like the structured products in the 1990s. It was just a bunch of insiders playing with each other and like blowing each other up. It wasn't really leaking out into like the traditional market, like Celsius and stuff like that has now millions of customers that are going to get wrecked. Just like in 2008, it eventually got so big that it affected everybody.
Currently wrecked. They can kiss that money goodbye.
So Celsius, how do we best describe Celsius? What is the best way to describe it?
So Celsius is so in the collapse of 2020, there's this one fund, FTX, which is kind of started this last year, started buying naming rights on stadiums and getting their brand out there more. They were one of the big whales in DeFi. They're like the JP Morgan that goes and rescues things.
But they were an exchange, right?
They are an exchange, but they also have a fund. Yeah, Alameda is the fund. So there's an exchange and a fund.
So the exchange has a fund.
Yeah, the exchange started as a fund. It was actually these traders, these quant traders, these like genius quant traders that made $1 billion or $2 million just trading in these markets, Alameda Research, and then they realized that all the other exchanges were kind of shitty and they weren't as good as traditional market futures exchanges and stuff. So they created their own because they're really smart devs. And now it's actually the best exchange to trade on. Most traders love FTX.
It's like when Enron tried to create their own exchange.
Did they really?
Yeah, they did. And then the banks didn't like it, so they created they if I remember correctly, they dedicated their liquidity to a rival. And then before the exchange wars could really take off, Enron collapsed. But yeah.
Okay, so this is what happened. This is the games like that were happening in crypto. Ethereum was the #1 blockchain for DeFi, but it became obvious that Ethereum was completely broken. Like Junseth said, MEV is not a good thing. It's not a good thing that you can have transparency in finance, because it's like when a bank has to go to the discount window to the Fed. Everybody knows that you're going to the discount window. They can see you're going there. It's reported.
Self-fulfilling prophecy. You end up self-sabotaging. So you avoid
something bad's going to happen going to the Fed window, right? So instead they go to like the LIBOR markets or something else, like you were saying, to try to avoid the stigma of like having your visibility into what you're doing. DeFi is like the entire thing is the Fed window. Everybody can see everything. Everybody knows everybody's positions. They know when you're going to get liquidated. They can see your stop losses. They can front run you. They can exploit you. They can research the DeFi coins that you're in and actually fund hackers to go and blow them up and cause you losses. It's insane. Everything is completely transparent. So at least we'll give it to DeFi that it's better than the traditional system in that you can see how crazy it is. In the traditional system, everything's opaque and we can't see how over leveraged and crazy it is.
This is not good for the concept that transparency is like the thing that sorts everything out, right?
But we knew that wasn't the case. Like the idea that banks in a capitalist system or in any system, the idea that competitors want to show you all their information is idiotic. Why, if you're a bank, would you want to tell everyone what you're about to do? Why, if you're a trader, would you like, this is why, like, pushing this idea of like Robinhood, for example, selling user data, and Andreessen Horowitz saying that, like, no, it's actually a good thing. It's a good thing. It's beneficial for you that we sell your trading data to these banks. It's obviously not, because there's value that's extracted.
But also, it's paradoxical because it only creates an incentive to create a dark pool or obscure or use sort of some sort of Machiavellian process to bypass the transparency. It's the Grossman-Stiglitz paradox, as I like to refer to. Obviously, that's the theory that perfect information is impossible in a market, because as soon as you achieve it, the incentive to to get the information goes away, and therefore inefficiencies come about because people just can't be asked to be in the market because they can't make any money out of it. So therefore, it's a permanent self-fulfilling prophecy, and you see that evolution with HFTs eventually kind of like having to, you see the counter response to hyper efficiency is dark pools, because you can't have a market if it's perfectly transparent.
But the efficiency of markets relies on market secrets. Like, it really does. Exactly. There needs to be information that is extra, is not known to the market, and that could, for example, be your own liquidity. And 100%. there's a lot of really amazing traders in the world that know this, like George Soros, for example.
Yes. So where were we in the story?
Okay, so we've got, like, Alameda is a big player in this story. Alameda, the research, is the JP Morgan. They're like the tier 1 crypto hedge fund. Then they own FTX exchange. Mm-hmm. What they also did was create their own blockchain called Solana. They pre-mined that blockchain called Solana because they're traders. The one
that Melania likes. Okay.
So Solana was basically like, we're gonna do DeFi, but in a better way. It's gonna be faster. It's gonna have some privacy. It's gonna be more scalable. So it'll be cheaper, so that retail will be able to afford it. Because on DeFi and Ethereum, you basically have to be a whale with like $700,000 minimum to even go bother playing in this thing, because it's like $50 a transaction. Sometimes it can cost you $500 to pull out of that curve pool. If you were to provide liquidity to try to be a market maker in that curve pool, it was like a $500 to $1,000 fee to get in and out. So like, you really have to be a whale to participate in Ethereum DeFi. So you had FTX, which is like a much more better operator for finance than the Ethereum folks, create their own blockchain to be competitive with Ethereum. Because if they can create their own DeFi blockchain and actually get the network effects stronger because they built something better in terms of faster and whatever, they could pre-mine their coin and just make billions of dollars by creating a market for their own DeFi system. And so they knew that in summer 2020, they knew that they were about a year away from launching, about 6 months to a year away from launching. And Ethereum was gaining significant network effects. They were attracting traditional people from the financial markets. People were leaving banks to come work on Ethereum DeFi protocols and create their own stuff. They were actually getting some pretty big headwinds in the summer of 2020. So what the guys from Alameda did was they came in and crashed the whole thing and brought it to its knees. So they came in as liquidity providers and they poisoned the well. Yeah. They attacked all these different protocols with liquidity attacks. They used their pre-mine of their coin as collateral in this lending protocol, borrowed against it because these dummies allowed you to put anything in there. So Alameda was like, well, we're just going to create a stall effect. We're going to like crash Ethereum DeFi as long as we can so that we can gain network effects so that we can be the number one DeFi blockchain. And of course, this isn't really talked about much because, the insiders know this is what happened, but not many people know this because it was kind of before it became well known, DeFi. But so they took $1 billion worth of their own token, put it up as collateral, borrowed Aave coin, Uniswap coin. I mean, borrowed Curve coin, but all the top tier one blue chip DeFi coins, they borrowed all those tokens out and sold them and shorted the whole market and crashed the whole thing. It like literally went from like to negative 95% in like 2 weeks. And it really put a chilling effect on DeFi because everybody got wrecked all of a sudden. It was like, oh, we're making money. This is the future of finance. And then Alameda comes in and just hammers the whole thing and says, nope, not now. So it was hilarious. It was like such a shark move for them to do that. But then, you know, fast forward, Bitcoin starts to rip. We get COVID. We get the stimulus. Everything reignites because the VCs are out there raising money. They kind of apologized, whatever. They took their funds back. They started building in DeFi, and then they created this multi-chain thing. So they tried to not only do the liquidity on Ethereum DeFi, they tried to create. So FTX launches Solana and puts up these massive pools of liquidity in Solana. So kind of competing now. Now you got Ethereum competing with Solana, and Binance, which is the biggest exchange in the world, crypto exchange, 10x more users per day signing up than Coinbase, global. They start launching their own blockchain too because it's too expensive to use Ethereum. They create the DeFi for the retail. They create the Binance Smart Chain. So you got now FTX, Binance Smart Chain. It's basically a copycat of Ethereum, but cheaper and faster and a little bit more centralized.
Very centralized.
So Binance starts funneling all the users into Binance Smart Chain and copying all of the protocols that were on Ethereum, all these like primitives like Uniswap and Curve and Compound and the Borrow Lens, all that stuff. So you start seeing copy and pastes of all of these DeFi protocols across the different blockchains. FTX is supporting Solana. Binance is supporting Binance Smart Chain. Then there's these other every crypto fund realizes, like, well, wait a second, we can redo summer 2020 of the Ethereum pump where we got all these DeFi coins like make us billions of dollars. So they all start supporting their own ecosystem. And then you start getting like Bitcoin goes on its run. It gives permission for them to deploy capital like crazy into 2021
because they had it.
That, you know, they had raised all this money. And they got all these pre-mines.
In this story, the blockchains are becoming analogous to just balance sheets.
Yeah, in some ways, yeah.
How do you
figure? How do I
like everyone has their own balance sheet and their own blockchain? Like so all that matters is whether your own system balances.
Well, Isabella, they're literally just organizations printing money.
Yeah, exactly.
Yeah, I suppose you could.
If you need more money, you just hit Control P and Control B for a blockchain. You get a blockchain, and if you have a significant number of people, like this is the negative incentive here. If you're an exchange and you have a lot of like super fans, your incentive is literally to hit Control P on a blockchain, print it, and you just have money. I mean, like FTX is a perfect example, right?
They're all like competing ledgers essentially, and a balance sheet is effectively a ledger system. That's a snapshot of we know what that is, but
right.
But what I mean is, like, rather than having to depend on like funding from an external source, you're just creating liabilities and creating assets at the same time that are unfunded.
It's kind of like I like that. I think I've been resistant to the idea of thinking about blockchains as countries, but the more I kind of get on with these explanations, I kind of think it is a little bit like countries creating their balance sheets, or in a way it's like they have the ability to just create the bond. Like the token is almost like the bond, and it's created from nothing.
Or the currency
it somehow has value.
It's the entire, it's the entire currency curve. Like it's, you've got the immediate cash curve. You've got like sterling in the case of the UK, and the entire sterling bond market that derives from it. And yeah.
And whatever it is, it's blowing up. And it's,
okay, we are going to get to the heart of the Celsius story.
now we're at the phase of the market where retail is getting involved in crypto because they're getting involved in everything, right?
So everyone's pouring into
GameStop.
DeFi now. Yeah,
All this stuff
this
is
is
going
the meme
crazy.
stock portion.
Elon Musk starts talking about Dogecoin. People are just off on the risk cliff, like looking for yield. Retail is betting on
many of my
sneakers.
friends are now like all of their crypto is in these various protocols. I know this at this point.
So at the beginning of 2021, you got like these tailwinds for things like Celsius, because in the 2020 bubble, it was very difficult for anybody to come in and figure out how to use a blockchain to like use decentralized finance and earn yield. Like that was pretty wild. But in 2021, all the exchanges started to integrate with DeFi, and all the centralized easy user experience points started to say, well, deposit your stable coins with us and we'll give you 8% yield. And what they were doing was, on the back end, they were just using DeFi and doing their own types of trading and lending and things like that. Like BlockFi grew really big because they were doing like the GBTC arbitrage sort of carry trade for a while.
Do you know about that? Do you know about that, Isabella?
No, but it's all shadow banking as far as I'm concerned.
Shadow banking, of course. Yeah.
It's so much dumber than shadow banking. GBTC was trading at a premium. So BlockFi was offering a huge guaranteed margin on like basically letting them loan, like giving them money to loan out. So they were putting the Bitcoins into GBTC, and then like once the GBTC would come back to them, they would sell it for that premium and then give the portion of that premium back to the seller. And so what happened is they did this so much that the premium got eked out, and now it's trading at a negative 30% discount to NAV.
Oh my god! Okay, it's only so many crazy concepts I can handle in a day. But okay, go on. Next.
Well, basically, the main concept of this part of the story is that there's now a user interface for DeFi, and it's you don't actually have to use DeFi. All it is, it's being marketed to retail and to high net worth individuals as yield, which is based on nonsense from DeFi. It's based on that house of cards from DeFi, but they put this like user interface layer over it, which is just a website. Celsius, BlockFi. Well, not so much BlockFi, but
I see.
All the exchanges, Coinbase, Gemini, all the crypto
they're just
exchanges.
trying to make it user friendly.
Well, they're trying to make you not know that they're obfuscating the fact that you are participating in this complex derivative product.
Yeah, they took away all the Ponzi scheme mechanics and just said 8% yield. And because
this is the point where like Novogratz and them start screaming, it's riskless.
Yes, that's where Novogratz starts going and talking to all of his Wall Street raccoon buddies to say like, yeah, look at Bitcoin. It's very interesting. Like it's digital gold, but just wait till you hear about Terra Luna because you can get 20% APY on your stable coins. So he's going and like selling like macro folks and institutions on the idea that you can get 20% yield in Terra Luna, and starts tattooing his arm with the Terra Luna, and Real Vision starts promoting all this stuff to all these macro folks, and all these Wall Street analysts start actually putting .eth in their names, and like Jim Bianco and folks like that start doing analysis on DeFi coins. And they start repeating the same mistakes we made in the 2017 bubble. They grab the utility narrative again and they say, well, because Aave is a borrow lend protocol, that means the Aave token is representing the value of the protocol, and you can apply a PE ratio to it. And based on the total value locked into the protocol, that means its price target should be. They start writing like 10-page reports on each of these things. It goes insane all through 2021, and people just drink the Kool-Aid. Mm-hmm. And so I'm here telling everybody at that time, like, you guys are crazy. This is all nonsense. I'm going on podcasts, and I went on Real Vision like 3 times to try to like talk some sense into folks, but nobody wants to listen in a bubble.
No.
And I mean, I'm predicting all these things are going to crash and they're going to go down 95%. It's going to blow up. Nobody wants to listen because they're making money hand over fist. And I'm just a toxic maxi. I don't understand financial innovation.
I think you
So-
understand it better than like anyone, Brad. I'm in awe. Like, no, seriously, you've
So-
done a great job explaining.
So the last bit here, then.
Well, I can explain it because it's been really difficult for me. I've just been learning about the traditional finance system over the last couple of years.
That's the key to understanding everything. What has come before
Yeah,
is very
it is.
relevant.
It was actually like, even a year ago, I was kind of still hanging on to old libertarian concepts of the Fed just prints the money and is the problem, and like there's fractional reserve banking, and I just was like, I was hanging on to these kind of like old boomery or like gold bug things where they would just make you emotionally react to the problems in the system without digging in and seeing how it actually works. And the more and more I dug into the system and the previous cycles of what happened to see things go wrong, the more I kind of realized that there's a lot more nuance than I was told. And a lot of it is it's simplified for people. Like when you say the Fed prints money, it's not really accurate, but it is a good meme. And
that's exactly right. I mean, that was one of my massive sort of bugbears for years during the whole like early days of QE. And I would go around saying it's not technically money printing, it's actually an asset swap. But nobody wants to hear that. Now,
it's just like nobody.
Brett, real quick, as another one, when you could use this trick if you want. When I go to places where there's high concentrations of libertarians, which I'm in often because I'm in Bitcoin, I actually carry with me last year's Fed audit. I print it out because libertarians
carried around like the Constitution.
Yeah, because libertarians say that the Fed never gets audited, and then so when they do that, I hand them a folder and they go, "Well, what's this?" And they never expect it. It's one of my favorite things to do.
It's like that's funny. The popular Constitution.
Fed audit 2022.
So anyways, what I was saying is like I think I'm good at explaining it.
Cover audit. It's not real.
Yeah, it's not a real audit.
I think it's like I'm good at explaining it because I'm a dummy. So like I can relate perfectly well with like a normal average person. I
told her that, Brad. I told her he's really dumb.
No, he's really smart. I'm very impressed. Okay.
Anyway,
so we're my number one source for all explainers now from now on.
So we're at the point where everything's just going crazy.
Everyone's putting their money in.
Yeah, it's like regular people are now being attracted by this yield concept, and this is just being sold at Coinbase, Gemini, and the Crypto.com is sponsoring UFC and the Staples Center, and like all these crypto companies are attracting celebrity partnerships, and it's just getting hammered over everybody. And at the very top, you've got people like Real Vision, Raoul Pal, the co-founder of Real Vision, Remy, went all in on Terra Luna, and they started sending this out in Raoul Pal's GMI like newsletter to all these high net worths and analysts and stuff that like Terra Luna was a great bet, and like it just goes insane. Everybody drinks the Kool-Aid, and they start signing up millions of people. And what they're doing really is, they're just creating a front end for DeFi, because what Celsius and what Terra Luna was doing. So with Terra Luna, you actually had to go and use the blockchain. You had to go and watch YouTube and figure out how to get into Terra Luna, deposit your stable coins. And, these exchanges were enabling it and creating bridges to these stable coins. Like you could buy the stable coin for Terra Luna's blockchain on the exchange. And this is so Celsius put $500 million of capital into Terra Luna. This is the thing why it all became interconnected. You remember how I was telling you about how there was a fungibility pool in DeFi between the stable coins? So Terra Luna's idea was like an evolution of the MakerDAO idea that started the whole stablecoin thing. They were like, we're going to create a whole separate blockchain just for MakerDAO. The whole blockchain is just going to be MakerDAO. There's going to be this token Luna, which these VCs have all pre-mined and got involved with. They're going to pump the price of Luna, which is going to create this ability for you to like collateralize Luna to make UST coins, which are pegged 1-to-1 with dollars. So the more the Luna price goes up in value, the more there is the room to create UST coins. And it grows from 1 billion to about $20 billion in the matter of about a year because of this narrative around yield and the bubble continuing to inflate all over crypto. And it was through DeFi that it grew. It was through things like Celsius. So customers were getting their deposits on, or getting their money and putting it in Celsius because Celsius was saying you're going to get 8 to 10% yield or whatever. Crypto.com, Nexo, all these yield things that were targeting retail. Plus, you got high net worth individuals. I can't count, like, there's probably like 6 or 7 people that came to me saying, like, I'm using Anchor Protocol to get 20% yield. What do you think? And I'm like, how did you even get to that point where you know how to use Anchor Protocol? Because Anchor Protocol, like, MakerDAO is not a Ponzi scheme. Like, the idea that it's just a high risk leveraged, like, financialized product. But Terra Luna took the MakerDAO concept and then put a Ponzi scheme marketing thing on top of it with the Anchor Protocol. The Anchor Protocol was like unsustainable hyper growth engine for Terra Luna UST. Combining that with like co-founder of Real Vision, Galaxy, all these like people endorsing it, it created the conditions for massive growth, and tons of people started putting their money in because it was sustained yield that they were getting. So this is the most insane part of what happened was you get Celsius taking customer money from retail, putting it into Terra Luna. You get VCs and high net worths and everybody else doing that. And then remember how I said they're creating bridges between blockchains? So they create the bridges between the blockchains. So they create a leverage mechanism so that you can go from the Terra Luna blockchain where you're getting 20% APY, and then you can take that deposited token. So when you deposit money into the Terra Luna, let's say you deposit $1 million into Terra Luna, right? You get back this token that represents your position. In a normal system, you just file that token away and be like, that's my token for my $1 million. That's
Not
my
in
receipt.
crypto.
Not in DeFi. In DeFi, they created a mechanism where you can take that receipt, deposit it into another one, and get another 20% yield. So you're getting paid to use your receipts. So you get paid to use your receipts. So you take your receipt of your 20% position, you deposit it again, you get another 20%. You get back a token that says you've got a receipt of a token. Now you've got a receipt. You take that receipt, you put it back in Anchor Protocol. Now you're making 60% yield. So now you've got a receipt of a receipt of a receipt of a synthetic coin called Luna, which is not worth anything in the first place. You might as well do it another couple times and get 100% APY. That mechanism of total nonsense leveraged synthetic garbage grew Terra Luna's ecosystem to at least another $10 billion because everybody was attracted to that yield.
And that's how it came out of nowhere to like become so big.
Yeah, because everybody was saying this makes sense. this is fine.
But it's all air. It's all
nothing. Yeah, it's all nonsense. So
then Terra goes down and explain that. So then we're at Celsius.
Celsius actually was one of the reasons why it went down, because they took out $500 million of liquidity like 2 days before Celsius went down. The looping thing. So back in January, when I was seeing this was growing Terra Luna so big, I'm like, this is nuts. Like this is the LTCM moment here. Like any moment, this thing's going to blow up. It's going to cause a cascading failure in DeFi.
Leverage.
And nobody's going to bail it out because there is no central bank in DeFi. So it's just going to blow up like 2008 should have. You know what I mean? But what happened was the peg started to drop on this UST coin. And when the peg starts to go down, that's the confidence loss. Like the Fed provides confidence in the markets, right? Like you said, the fungibility between the shitcoins of the commercial banks is, in the end, it's fungible because the central banks provide confidence. The Terra Luna guys decided to be hubristic and say, we're going to back it. We're going to back it by $3 billion of Bitcoin. So they tried to act like the Fed. And, when the Fed comes out and says they have infinite money at the Federal Reserve and all that, that's just a confidence game. They actually can't stop a liquidity crisis if it actually happened. but they provide the confidence signals to the market so that hopefully that's enough to stop the crisis. In Terra Luna's case, it wasn't enough, because once people start to actually realize this thing is depegging, and they start to realize,
as I argued before, the actual act of collateralizing it with Bitcoin sent the inverse signal to the market. It actually highlighted that they didn't trust the protocol.
Exactly. The protocol was completely broken, and they needed to provide this confidence game to the market. And Celsius took their money out, which caused a massive liquidity suck, which enabled it to be exploited by whoever.
This is where I have a very nerdy question. So when Celsius took its money out, it took out UST, right? So it ended up
actually they
sparking the collapse, but also ended up like holding like valueless UST, or did it?
They took out what the most of the money they took out was their actual receipts. So they unwound all the receipts and took back the ETH, the at the time, which was worth a lot of money.
They went all the way. They rewound all the way to get the ETH back,
to get the main collateral back from the Anchor protocol. And then I think they probably sold all their rewards, which would be like, I don't know if it was UST or whatever it was, but that was a big confidence thing, saying that like, so Celsius is one of the biggest pools of capital that was trusting the system. And when they pulled everything out, it was like, oh, well, maybe I should also pull out. Like, people, once these like panics start, right? Like, the smartest thing to do in the game theory here is like to just get out with your money, protect your assets. And this is like what Junseth, when I explained this to Junseth a while back, like back in January, he's like, if you could figure that out, you better know that some smart like Wall Street fund has already figured this out, and it's just a matter of time before they short the whole thing and blow it up. And it was like a couple of months later that happened.
Such a mirror of what happened in 2008. It's actually hilarious. And we even had Jim Cramer, I think, from CNBC, back in March, like maybe even May, talking up the market and saying it's going to be fine, like he did with Bear Stearns. I mean, the mirror is insane. So okay, so now Celsius has pulled all its money, Terra Luna's gone down, and what's happening between now and the suspension of withdrawals that happened this week?
So why I was predicting that Celsius was going to be the next domino to fall after Terra Luna fell was because Celsius lost a significant amount of their funds in DeFi and didn't disclose it, because I have like friends, I have friends in this ecosystem that kind of keep me posted on things, and I watch wallets and stuff. And I didn't know for sure that they were insolvent, but I suspected that because I knew they'd lost like 30,000 ETH in a stupid mistake where they deleted their smart contract key or whatever. Like, it's the dumbest thing. They just lost the key.
When did that happen?
A year ago, and they didn't disclose.
Hello, Isabella.
To recover that lost capital, and they've probably been taking more risk to try and like earn it back, right?
Hello, Isabella. This is Wells Fargo. We accidentally deleted all of your money. It's gone. Deleted it.
Gone.
We hit delete, and it's gone. 30,000 gone.
Pretty much.
It's ridiculous.
And it's funny because that news got swept under the rug, because it just so happened at the same time that happened, two other really bad things happened that took all the heat from them. So they got kicked out of the UK and for rehypothecation, and their prime broker, basically like their custodian, kicked them out as a client for risky rehypothecation. So they were dealing with all these headlines about like Celsius loses its status as its custodian, and a couple of other things that happened, and they swept it under the rug that they deleted the key and lost all this customer funds. Couple months later,
it's funny every time. It's hello, Chapo. This is HSBC. We apologize. We deleted all your money.
Another thing too that they did was they started this anonymous account, and this is kind of underreported too. Not many people know about this. Celsius started this anonymous DeFi account called OXB1 on Twitter, and they started with $100 million, and they grew it in 2021 all the way up to $1 billion. So they made $1 billion through doing all this risky DeFi stuff and freaking buying NFTs. They were doing NFTs. They were buying Bored Apes and CryptoPunks and all this stuff, and they got the account up to $1 billion. When China banned Bitcoin, a couple of months later, they were way over leveraged on that account, and it went to zero. You could see it on chain. They went negative. The account went negative. They owed like 50 million or something like that. So I was looking at this. I'm like, wait, how could they take such a crazy risk? It can go to zero from $1 billion. They can lose the keys. Man. They get kicked out of the UK. Their prime broker kicks them out for rehypothecation. A couple of months later, the CFO gets arrested for fraud for participating in Ponzi schemes in Israel. The CFO of the company.
Brad, I don't think that people understand leverage. It's very obvious to me that people in this space and generally in other spaces don't understand leverage. Like, it's funny. Libertarians like to talk about easy money, right? Like y'all, I guess you maybe not so much, but libertarians generally are obsessed with easy money. Right? Would you say?
Yeah. They think it's.
I don't hang out with libertarians.
Well, what's easier than collateralized loans against for your own that you put your own like equities against? And like the reason I say that is because like generally the idea is that easy money just makes it really easy to get access to money. It's not a difficult concept. So when these protocols develop this way of basically putting in a little bit of equity, and you are able to get back 137,000%.
Insane.
You end up with this hilarious world wherein libertarians love giving themselves easy money. They collapse.
That's what I've always said, Josh. I've always said that like we're just recreating the old system under.
Yeah, but Isabella, your entire life philosophy isn't based on the fact that easy money is bad, and that you yourself are so smart that you should be allowed to make decisions for yourself because you are Mr. Super Smarty Pants.
But are the libertarians into DeFi? Like I thought the libertarians are more really.
I don't see many libertarians in my daily like circles. I bet you some of them have libertarian views, but
I don't think that's the case. I think DeFi is quite a politically agnostic area now.
A lot of people in the left and on the anarchist side are for sure attracted to these things because they hate Bitcoin because it's apparently bad for the environment and they missed it, and they've been critical of Bitcoin for so long that when they see something that can give them yield, and they're like, I have so many friends on the left that were like, I don't like Bitcoin so much, but I'm into DeFi and I'm getting 20% on Anchor Protocol. And I'm like, oh my God, how can I save this person? Because I've been like telling them for 10 years to buy Bitcoin. And now in 2021, they're actually shoveling their money into Ponzi scams. It's seriously, I think it was the yield. The yield attracted a lot of people. It's a serious temptation to get 20% interest on your money. And that's the biggest fraud in this cycle, was legitimizing these risky, toxic things as if it's yield.
What I want to know is who was the kind of like stereotypical client of Celsius? Was it like, the cliche of the dentist type back in 2008, or is it the
everybody? It's everybody, and it's not just Anchor Protocol, Celsius. I was because I guess I'm like a sentiment vacuum. Like I constantly am watching for what retail's doing, what my high net worth circles are doing, like what Bitcoiners are doing. I'm just trying to like hoover up sentiment and see where we are at the cycles. And it was obvious that we were at the peak of the bubble back in like January 2022.
I mean, I was watching. I was at a conference that I'm not sure if it was Chatham House or not, so I won't mention who organized it just in case. But it featured quite a lot of high net worths, and they were talking about allocating 10% of their portfolios to crypto and this sort of stuff. I thought that was insane.
a lot of people were putting money into it. It wasn't just retail. It wasn't just Gen Zs spending their stimmy checks. It was like entrepreneurs. I have so many entrepreneur friends worth like 8, maybe even 9 figures that were putting in millions of dollars into these Ponzi schemes, and I couldn't stop them. Some of them I did, and I've gotten so many text messages over the last month or two being like, "Thank God you
by the
told
way,
me."
notably, these people that are starting to get here now and putting their money into DeFi, these are the same people that told me 8 years ago that Bitcoin is a Ponzi scheme and insisted that they were certainly right. And when they got here, they were so arrogant that when we told them that they were in Ponzi schemes, they told us that we were idiots.
Well, since you are, I think my, historic readership would be confused by that, because I think they would bag everything together, right? So why would you differentiate Bitcoin from all this other stuff?
Well, Bitcoin is the thing itself, right? It's literally like gold, if you will. People say Bitcoin has no backing. That's because the thing itself doesn't need backing. It's the Nike shoe, not the Nike stock in a sense. And
is that because of its quintessential link to proof of work and energy? For me, intuitively, I think that's what gives it value, because you are expending energy to create it. Therefore, it is something. It has achieved. You cannot just hack it through all these other mechanisms. You have to spend energy.
It's proof of work. It's proof of work certainly matters. But the other thing that matters is that, people talk about Bitcoin being made pristinely, but it's different than that. Bitcoin was made without hubris. So the creation of Bitcoin is in some ways a little bit perfect. It doesn't have, like, Satoshi Nakamoto didn't design it with a desire for profit. He designed it as an answer to a math problem. It's the answer to the Byzantine generals problem. And what comes out of it is this token. It's like oil in that way. You can't put it back in the box. You can't delete it. It's here. Nothing you can do about it.
But what about all the lookalike coins that use exactly the same protocol?
All of those.
The way I like to answer that one is that, like, Bitcoin, like John Seth said, solved the Byzantine generals problem, and crypto created the Byzantine generalist problem. And we're seeing
here's the thing,
generalist problem explode right now.
The only thing that matters with regard to this stuff is scarcity, right? So in principle, if you can print.
Back up just a little bit, just for those who might not know what the Byzantine generals problem is. Can you explain very quickly, as easily, like pretend I'm an 8-year-old?
Okay, so the idea is that in a computer network, well, it starts out with like this analogy about all of these generals, but like let me boil it down in the computer sense. The idea is, if you have a computer network of lots and lots of computers, is there a way to incentivize everybody in the network to contribute to the network in a positive way, even if the incentive exists to attack the network? Okay. Mm-hmm. So like in the case of Bitcoin, it's money, right? So how do you make sure that everybody who's contributing to the network is honest? It's nearly impossible, right? Well, so Bitcoin does it in various ways, but the ways in which it does it are called proof of work. Okay, the ways in which the network comes to consensus about whether a person has told the truth when they've contributed to the network is called consensus, and that moves it forward. And the way in which a consensus is achieved is people plug machines into the wall, and they run the network this way. Bitcoin's kind of like a machine that lots and lots of people are taking energy out of their walls for, and this global network of people achieving consensus, creates this chain of blocks. And there's another way to do it that some other people talk about. Politicians in particular love to talk about. It's called proof of stake. And I would ask you this, like, if you want to quickly debunk proof of stake, think about running an entire economy on proof of stake. It basically says that a proof of stake coin, because it doesn't use a lot of energy, but what it does do is it gives the biggest holders the most return. Because in a proof of stake system, if you have a lot of it, what happens is the network rewards you with more. So Elon Musk is the richest person in the world. Elon Musk would get huge paychecks in this proof of stake system if it were reality. and Isabella would get $3 a month. $3 a month. So proof of work is really the only way to tie these blockchains.
As a newbie, proof of stake just seems a replication of the current system.
Yeah,
It is.
It's worse though. It's again worse as everything in blockchain. So proof of stake is the only real legitimate way to tie this sort of ethereal
Proof
coin.
of work.
Proof of work is the only way to tie this like non-existent digital coin to the real world, and you have to have a real world anchor. So once you have proof of work, you have a real world anchor.
Yeah.
Now you basically have to ask yourself, like, what's the difference between two proof of work coins? And the answer is that one is better than the other. And the people that are burning energy will slowly move to the one that is better. Always. It will always flee to the one that is better. For some reason, there's a lot of idiots who don't think that's true, and they're mining a bunch of coins as a point of significance.
That's just the new first entry advantage.
Yeah, well, in part, but it's more than that. It's that the others are built with flaws, and Bitcoin is not. They're built with flaws to enrich the creators.
Exactly the way that Bitcoin was created.
So you just like redo Bitcoin tomorrow? I mean, you'd get no network effect. So yeah, in that way, it's. I mean, that's essentially what Litecoin did, right?
Yeah.
Yeah.
Litecoin
had flaws.
The way I like to look at it is like as a parallel to the financial system, is that the U.S. Treasury right now is kind of like the base collateral of the entire world, and you have to trust that the U.S. Treasury is going to be able to pay its debts and that they're not going to make too much of it. You can't audit the supply in the next 10 years of what the U.S.'s debt is going to be, and if you're a counterparty now, like that is not politically aligned with the U.S., you're cut off from trading in that base collateral of the world. As we go more and more into a world where trust is continuing to be lost, we're going to basically enter into a post-trust world. We're entering into that post-trust world currently with the Russia-Ukraine war right now. Ray Dalio has a really awesome YouTube video that kind of describes the breakdown of trust and the breakdown of reserve currencies and reserve assets. Bitcoin is auditable by everybody that wants to audit it. The rules are set in stone. Nobody can print more Bitcoin. So it is the perfect collateral in a post-trust world. It's not that next year we're going to start transitioning to using Bitcoin as a collateral for global settlement between banks and central banks and countries, whatever. But it's possible that in this world continuing where we see the decentralization and the balkanization of global reserve assets, Bitcoin is a uniquely positioned asset in that any central bank can just hold their own keys and not have to worry about not getting their gold back, like what's been happening. Like there's so many examples of sovereigns being censored by the US or the NATO or whatever, and like getting kicked off the SWIFT system.
Right.
And as we continue on into this world,
I agree with you because I think that's where I made my we've discussed this at length. Everyone's probably bored of it, but that's where I have changed my mind. Is I agree with that principle, but I'm conscious of time because it's 2 hours, and I think our viewers are not yet ready for these long.
Sure.
Right. To take a bathroom break, everyone come back. We have another 2 hours. How about we close this off with this song you've been telling me about by the Winklevi?
Yes, that's what I thought.
Brad can watch it too. Brad, have you seen this?
I want to thank Brad because I love Brad.
Let's wrap up the Celsius thing. We'll tie a bow on that.
Oh, tie the bow, Brad, quickly.
With the fun stuff. Go on.
So Celsius had a loan with Tether, a $1 billion loan directly with Tether. And many people, like the Tether truthers, were out there saying that Celsius was providing or got $1 billion printed from nothing from Tether. And that was risk to Tether as well, because apparently people thought Tether was out there giving all these free loans, like LIBOR style, uncollateralized loans to all these risky crypto companies and crypto funds. And so George Noble and Bennett Tomlin and Caspian Sea and all these, Bitfinex, all these people on Twitter that are pushing this like fear porn that like USDT is gonna blow up like the Anchor coin UST did. because they're doing all this risky stuff, are just frothing at the mouth, hoping this cascades over to Bitcoin and Tether. And, I was kind of like concerned by that too. I was like, well, are they actually using Evergrande bonds and, Celsius corporate paper to back Tether? Like, I don't want to be defending Tether if that's the truth. So I had a Zoom call with Paulo and Samson Mao, and obviously don't trust verify. Like, this is just what I've been told. I believe they're telling the truth. But he told me that they don't take that kind of risk with the treasury because they're making enough money being conservative because they're Bitcoiners. These guys have been around since the beginning, the early days of Bitcoin, and they've done a lot for the Bitcoin ecosystem, even though Bitcoiners don't recommend you use Tether. Like, we like Bitcoin. We don't like Tether. But when people attack Bitcoin through Tether, we tend to kind of speak up a little bit because a lot of it's nonsense. But so I asked them specifically about 3 months ago, like, did you loan $1 billion to Celsius based on corporate promises and, like uncollateralized, LIBOR style stuff?
So Brett, so Tether, you don't think has any exposure?
They don't. He told me that they only do 2x collateralization. So they had.
So let's get to the part where Celsius collapses just for time. So
Celsius had about. This is not. I don't know 100% how much of this is accurate. This is just based on my calculations, having conversations with Paulo and Tether and watching the blockchain and stuff. I think Celsius had about 60 to 70,000 of customer Bitcoin locked up as collateral with Tether of the 150,000 Bitcoin that they had. And the other day when we had that huge price drop, the 21, we got into the 20s. That's when Tether got liquidated, when Celsius was liquidated by Tether. According to Paulo's Twitter, they have no exposure to Tether anymore, to Celsius anymore. Celsius has been liquidated, no losses to Tether. So that means that that's the same day that Celsius hired the restructuring law firm, and pretty much they're illiquid. They're insolvent because they've been liquidated on the loans.
I see. So it was Tether that pulled the plug on Celsius.
Yeah, to protect the Tether peg. They just liquidated them.
That's only logical. Tether is in such a precarious position that they had to, sell those assets, right?
So Celsius was taking extremely.
Today, I guess they did some sort of evaluation or credit stress test on Celsius, determined that the loans are probably underwater or.
No, actually, so
what they had Bitcoin, so it'd have been an LTV, right?
Right.
Yeah, they had Celsius took customer Bitcoin, deposited it with Tether, and got $1 billion of Tethers to go then use in DeFi and go do all this nonsense in DeFi.
Must be so happy.
They probably made a lot of money.
They're like, you won't believe we are going to liquidate.
So it wasn't the case that Tether was lending to Celsius or rehypothecating customer funds. It was more that Celsius deposited the Bitcoin in Tether as collateral.
No, it was that Tether was lending, but they were lending by over collateralization with the customer's Bitcoin. So Tether lent Celsius $1 billion with
Tether's treating the Bitcoin as the pristine asset. They're not taking unlike these DeFi protocols, they're not taking Celsius or Aave. They're taking Bitcoin. So
and then as the price of Bitcoin came down so much, they were no longer in good standing with their loan, and because they were so
margin call.
It was a margin call, yeah, and they were under pressure because they've got hundreds and hundreds of millions of dollars of customer deposits locked up in DeFi with all these other loans that they can't access.
The margin call.
So they had no choice but to freeze customer withdrawals and try to keep defending the margin calls. And as the price got pushed lower, they got liquidated, and now they're insolvent. That's the story of Celsius.
And what is the protocol in terms of like communicating this to all their clients? It's only like
radio silence. That's what they've chosen. Just not to say anything so far.
That's what I would do. I'd buy a yacht.
Apparently,
I'd be like, it's maritime law time.
So the dudes at Celsius? It's this Mashinsky guy, and who's the other co-founder? Do we know?
I'm not sure, but they've been instructed by their legal team to not do anything, not say anything. They're probably
having cold sweats right now because There's going to be a few people after them. I would
Well,
imagine.
and then Alameda. I mean, Alameda made out like bandits, the FTX folks as well. So there are some people coming out on top of this. This isn't going to be like all of crypto's crashing, but I do believe that a lot of these risky people that were doing all this DeFi are going to get wrecked, and a lot of these DeFi things are going to lock up because as this bear market continues, we have not seen capitulation yet in the crypto coins. I do think we've probably hit close to a bottom in Bitcoin because like Bitcoiners are not doing all this stuff. Bitcoiners are just holding Bitcoin as a savings vehicle. We're not out there taking crazy leverage and trying to do all this financialization and
Speak
trying
for
to
yourself, Brad.
But typically, like, you know, the big whales that were holding Bitcoin, like Celsius, like Terra Luna, like Three Arrows Capital, that were doing all this stuff, they've been, you know, the tide came out, they were exposed, they got margin called, and I think a lot of the sell pressure has already happened on Bitcoin, but it's going to be nothing but pain for the next year, I think, in DeFi. And I do think the liquidity is going to completely dry up like it did in 2008, and that will just decimate DeFi. I don't think DeFi is going to come out of this.
Yeah, no, I would agree. And then just 3AC, they're a hedge fund. Who are 3AC?
Yeah, they're one of the tier one crypto funds that was propping up a lot of this stuff with liquidity and providing loans, and you know, like they had a lot of exposure. They're basically like kind of like an LTCM where they were the smartest guys in the room doing all this quant stuff, and you know,
But they're not in
blew
trouble
up.
yet.
No,
Or
they
do we
blew
know?
up. They're
They did blow
done.
up.
Yeah,
They're done today.
2 days ago. Same
2
as
days.
same around within 24 hours of Celsius.
Yeah,
They also blew up.
I see. And do we
So
know who
it's-
is? Were there any celebrity names endorsing it or anyone associated with that one?
Not any celebrities, but they were one of the biggest funds, and you know, it's been reported now that they got up to $18 billion, and now they've got like 2 left, and they're having problems meeting capital calls and stuff. So there's been so many tweet threads about people that are exposed to Three Arrows Capital that now they're having problems because they can't, you know, they got loans
That's
out
how
to Three
the
Arrows.
contagion is gonna
Exactly.
like move through the system. So who would be invested
Oh,
in?
we got a lot of room for this because there's a lot more contagion where that's like this is just
Why
the
don't we
beginning.
revisit this? Like, this is a great curtain raiser to like what I think will be a series of like
collapses.
crypto
Yeah.
DeFi disaster zone.
What's interesting, Isabella, is in the real world as things happen, like we see cascading collapses all the time. Like we saw it in like 2008, right? Housing market went and blah 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 blah, blah, and then the whole world just kind of like it feels very much like you have these two different sides of finance, and they seem to like have independent cascades. Like I can't foresee, for example, a collapse in the crypto market having an effect on the housing market, right? It's very interesting. It's like a completely independent cascade.
It is. That's what's interesting. It is kind of compartmentalized to a certain degree, but because Coinbase was listed, right? That's where the contagion pathway, because pension funds can like once you've got the miners are listed. There's a lot of listed stocks. That's the pathway to the real world.
Isabella, maybe, but however, you should know this: a pension fund in Canada had Terra Luna.
Really?
No, the 400 million invested in Celsius.
Oh, Celsius, that's right. They
put 400 million in Celsius, the Quebec pension plan.
How are they allowed to do that with their mandate?
I think wasn't it a teacher's
pension plan? I think. Yeah.
No.
Yeah.
It's so
Insane.
funny. It's so
That is
funny.
actually
And then
terrifying.
the quote of the guy says something like, we're looking
Like
at
it's
these protocols,
zero.
we just-
It's gone
we're
to
looking at-
zero.
Yeah, it is, the quote of the guy's like, we're looking at these protocols, we're going to put money into, a few of them and definitely not into anything like Bitcoin.
Yeah, exactly. It's like that Bitcoin's too risky.
Okay.
Well, there was another startup too that grew really fast. It was a Y Combinator funded or accepted startup that grew to about $50 million under management under assets, and what they were doing was providing yield for people. So, they were giving you 8% yield, And
Wait. First of all, okay, we're really running out of time, but that is hilarious. Like, my business model is just providing yield.
exactly.
That's what I do.
And
I just
it came
provide
out.
yield, and I just make it. I just make
It
the
ca-
yield, and I give
It's
it
like
to you.
it's like a cake.
It came
You
out
just
that
bake it in the oven.
what they were doing was they were just taking the money and putting it into Anchor Protocol.
Yeah.
And they were getting 20% and giving the customers 8%. And
It's
that
just-
thing blew up. It went to zero.
It's so funny. I
But
think
it's also just like a reprise of everything that's ever happened before. But
it's
on that,
wonderful.
look, I have really enjoyed like talking to you, Brad, and always, I always enjoy talking to you, Josh. But I think, given the cheery mood in the market, one duo that have not given up believing in it all are the Winklevi, the Winklevoss, and they wowed everybody this week with a amazing rendition of Journey's "Don't Stop Believing." Josh, you have not
Important
seen.
message. It's an important
Huh?
message, I'm sure. Don't stop believing. It's an important message in this era of turmoil.
But I think we need to watch it.
Let's do it. I haven't
Let's
seen
do
this, so I'm
it. Have you
excited.
seen it, Brad?
I listened to 5 seconds and I turned it off.
We're gonna watch it. We're gonna watch it all.
Okay,
Here it
let's
comes.
go.
Can't be that great.
Running halfway through.
It's okay. That's all right. That's all right. Ouch. It's like a dead cat. Well, he can play the guitar. Why is he? Why? You know, they're so tall that guitar looks like a little like a tiny ukulele in his hands. That is some bad. Is that their band?
That is their band. How
Fired
like,
up,
what-
guys.
How does that happen? Like,
I think
how
when
does
you have enough money, you give up on life, and you just I think that's now what we call
does he not-
retirement.
does he
He's a
not
good
hear-
guitar
does he not
player, though.
listen to himself.
I think that's what we call retirement now. You don't go to the retirement home. You start a band. When kids are 18, they're like, I want to be a rock star, and their dad's like, okay, yeah, whatever. That dream will die when you're like 22, not 18. Like when they're like 8, 9, 14, and then they turn 22, and they're like, I can't be a rock star. I'm going to go to college and be an engineer. And dad's like, okay, that's more realistic. Yeah, you do that. Apparently now, at around the age of 40, when all of us millennials retire because we're very wealthy, you again go, I'm going to be a rock star. And then you do it because you got money now. So who cares? And you still fail, but now you got nice equipment.
I know, but they're a laughing stock. It reminds me of the time that Katie Price, who is, I don't know if you know who she is. She's like a celebrity former glamour girl in the UK and married to Peter Andre at some point.
I don't know who either of those people
Sing
are.
at Eurovision, and she can't sing. And it was embarrassing, but apparently not a problem.
But Isabella, who really is the cringe fest? The guys with like $7 billion or all the poor people in the crowd?
on that really deep philosophical point, I think we'll end it. But unless you want to sing us out, Josh, I think go on.
Go. Not that song. I've got the world on a string, sitting on a rainbow, got the string around my finger. What a world. What a life. I'm in love. I've got a song that I sing. I can make the rain go every time I move my finger. What a world, what a life, I'm in love.
There you go.
Wonderful.
You might not have the billions, but you've got a voice.
I also might have the billions.
Ah, yes. Let's go. The billions. Okay, very good. Well, thank you, Brad. It's been a pleasure talking, and I hope we check in with you again, and that you will help us understand all sorts of other. Well, quick prediction. What's next?
I really do think that the next phase of this collapse is just all these tier 1 funds taking their liquidity out, and then once the liquidity dries up in DeFi, it's just all going to fall apart. It's going to be just a mass failure of all these protocols and stuff, because it's all based on these honeypot liquidity pools, and once the losses become enough, they're going to be like, why am I going to bail this out? This is too risky. So they're just going to take their money back. Once they take their money back, it's just all going to get wrecked.
It's all going to get wrecked. So basically,
Except Bitcoin.
You ain't seen nothing yet, is the conclusion.
Dumb.
All right, I'm stopping the broadcast now. Thank you very much. Take care. And there we go.